We'll talk about comments from Secretary Blinken. They're serious comments, but I just want to talk about where those comments are coming from. Are they in Capri? Is that where they are?
The
G7's in Capri?
The G7 presidency is the Italians, and they decided to have the foreign ministers meeting in Capri, and I cannot say, and before they went, I said, this is so tone deaf.
Is this basically Greece? We're going to go to, like,
amazing.
you know...
That is
Capri
amazing.
might be better than Greece. Don't tell the Greeks I said
To foreign ministers at Il Ricio Beach Club, you enjoy yourself. Up next on the programme, Israel striking back.
It's a limited response that shows a signal that we can do more. But of course, the Iranians are spinning it as, no, we shot these things down.
That conversation up next, live from Washington, D.C., from the nation's capital, for our audience worldwide. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Coming off the back of 5 days of losses on the S&P 500, wrapping up the week with maybe another one. We're negative by 0.3%, but we are recovering. We're just about session highs on the S&P 500 right now. Yields are lower by 4 basis points, 458.99. The first thing we all checked when we woke up this morning, where's crude? I can tell you. It's lower by 1 full percentage point, 81.91 on WTI. Under surveillance this morning, Israel striking back.
It's a limited response that shows a signal that we can do more. But of course, the Iranians are spinning it as, no, we shot these things down. And one of the things that we have to think about is, what does the White House think? Because, of course, the White House said, don't do anything.
Here's the latest this morning. Iranian state media confirming an attack by Israel earlier this morning, saying the drone operation failed. The IAEA saying there is no damage to the country's nuclear sites. Terry Haynes of Pangaea Policy joins us around the table here in Washington. Good morning, Terry.
Good morning, John.
Difficult to have a conversation about this in many ways because we have such little detail about what's developing. Let's assume these strikes have taken place based on reports. I'm not sure the nature of them, the targets, if they came from drones or missiles. Let's talk about the White House, as Doug Redeker did there earlier on this morning. The degree of influence they have over events in that place, in that region. How much influence do they have?
Well, not that much, and it's never been that much. You know, frankly, one of the reasons I go on about it being the highest geopolitical risk in 50 years is very simply that that was the time of the Yom Kippur War, when there were nuclear threats from the Soviet Union and all the rest, combined with a lot of domestic unrest and unease in the United States. And that still happens today. But the United States has given conflicting signals for the last 3+ years, and that's taken a toll on its ability to affect events in the Middle East, frankly.
Terry, conflicting signals for sure when it comes to this White House and how they communicate with Israel. This morning you wake up and there's a fresh report in the Wall Street Journal that this administration wants to send another $1 billion worth of weapons to Israel on top of what Congress is debating.
Yes.
Politically, how fraught is that for Joe Biden?
I think it's very fraught. The mixed messages here send a very bad signal, and they send a bad signal at a time when Congress, frankly, is debating exactly what to do and how to do it. I imagine there's going to be some kind of congressional response about that, and it tends to undermine the president's own authority and ability to argue what the foreign policy of the United States ought to be to the Congress, much less anybody else.
Congress is adding sanctions on Iranian oil, but we already have sanctions out of the executive branch. What Congress potentially may pass, would that actually go after the secondary, the issues, the refineries in China that are taking in this oil?
I think that's potentially the case, yeah. What you're going to get from this, from the consideration of the House bills this week is a Senate response that's, I think, is frankly going to take a couple of weeks to develop. And it's very much on the table, and certainly with Republicans, and I think probably a lot of centrist Democrats in the Senate as well, just how far and how much they want to direct the White House to do this. So the White House needs to actually continue to be in front of the troops instead of being behind them. That's a difficult problem.
There's no appetite from the White House to enforce these sanctions.
No, but apparently not. I'm completely with you on that. But I think there's a restiveness here in Washington that something's going to happen sooner rather than later.
When you speak with people in the market, what do you tell them about this administration's willingness and ability to sort of cap oil prices where they are? Because essentially, that's sort of the baked-in assumption that at some point there will either not be the enforcement of sanctions, as Anne-Marie was talking about, or else you'll unleash the Strategic Petroleum Reserve heading into the election season.
I think if you're relying on assumptions, you're relying on rather too much. I think there's a situation here where that's clearly what the White House wants to do, but events, I think, may overtake them on this. And there's a political, and let's not forget the kind of underlying political advantage for Republicans in all this as well. I mean, they can wrap themselves in not only in the flag, but also in a political advantage that will help them and disadvantage Biden by frankly making prices higher.
Well, I'm looking right now at the average price of gasoline in the United States, and right now it's $3.68, which is the highest level going back to October. Still not necessarily at the historic highs. Right. Is there a level that becomes politically toxic from a historical perspective for oil and gasoline?
I'd say roughly $4.50 a gallon. The reason why I say that is because I think very simply that I think $4 tends to be tolerable, and it'll jump up and down within that range. But when you get to an embedded 4+ or even 5, as it was, say, in 2008, I think that's intolerable, and that will snap back very negatively on Biden.
To what extent do you think that's guiding policy, maybe even exclusively in the Middle East right now?
I think it's a big factor. I think it's frankly a bigger factor than it ought to be, but that's that's another whole discussion. The bottom line here is, though, what the president has to do has to much more forcefully talk about American interests and spend much less time thinking about the political advantage, and that's going to be a difficult one.
Well, if that's the case, then why isn't he going out and touting the fact that the United States is producing more than 13 million barrels a day? This is a record no country in the world has ever reached. Not Saudi Arabia, not Russia. It's astonishing, and yet he won't say it.
Well, he won't say it because large parts of his base don't want those sorts of things to happen, and you've got a lot of mixed messages and a lot of strains on what the Biden energy policy is. Right? I mean, he won't talk about that. He was in Pittsburgh the other day talking to the steel workers about the U.S. Steel deal. But at the same time, 15 miles away is kind of the world capital of fracking. Town that I happen to be from, by the way, but not that matters. The world capital of fracking, and he's not going anywhere into that area to talk to anybody about his LNG policies or why that's good, bad, or indifferent for the United States. The net of this is for his politics in Pennsylvania, I think, is very negative. for exactly that reason. He'll talk to one kind of constituency group but ignore a whole big swath of other issues, in this case, energy.
Can we just end on, we're going to get this vote in Congress tomorrow.
Yeah.
TikTok, do you see it being banned before the election or not?
I do before the election. I keep saying this, and one day I'll be right.
You don't think the White House will have that extension?
Well, I think what will end up happening is, in Congress, what tends to happen is if you're doing a package of bills, particularly, you focus on trying to maximize the votes on the stuff that you really want. In this case, it's the aid package stuff. The TikTok stuff, among others, is very important, but you don't have a consensus on that yet. Until you get the consensus on something, it's not going to happen. And I tend to think both the White House and Senate Democrats want to play around with this particular ball string a little while longer.
Hey, Terry, you're one of the best. Appreciate it. It's great to catch up.
John, thank you.
Good to see you. And thanks for having us in your hometown.
Oh, no, anytime.
Terry Haynes of Pangea Policy. Coming up on this programme very shortly, we'll catch up with Adam Poston of the Peterson Institute on why he's expecting a stronger US dollar. That conversation just around the corner. Equity futures on the S&P 500 recovering just a touch. We're down by 0.25% on the S&P 500. In the bond market, Treasury yields are lower to close out the week. They're just about higher through Thursday, almost across the curve. On a 10-year, we're back down to about 460. Elsewhere in the commodity market, crude down by basically 1 percentage point now. WTI is 81.93, backing away, even with reported strikes from Israel on Iran overnight. Live from Washington, this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Things really are improving as the session grows older. Equities off the lows even more, negative by 0.2% on the S&P 500. Check out the Nasdaq down about 1/3 through Thursday, coming into Friday. 5-day losing streak on the S&P, the longest since somewhere in October, mid to end of October. So quite a stretch of gains before we got this stretch of losses. In the bond market, 2-year, 10-year, 30-year, looking at a 2-year, getting close to 5% again just in the last 24 hours, backing away by 2 basis points today to 496.64. I want to stick on the front end and talk about some of the voices we've heard in the last day or so. Things are starting to change. Just the conversation. I think we've said repeatedly throughout this morning, it's not the conclusion that's changed, Lisa. It's the conversation they're having. To hear the New York Fed President John Williams feel the need even to have a conversation about the prospect of higher interest rates if they need to, tells you how much has shifted in the last few weeks.
Dare I say they sound more hopeful than confident? Can I just say that? Because essentially, that's kind of where we're at, where they're basically talking less about we are definitely sufficiently restrictive. We think we are sufficiently restrictive to bring down inflation. We have to have more evidence. We're not totally confident based on the evidence that we've had. And yes, you can call it a U-turn, but I think it's actually they thought they were making a pivot on better data, and that influenced some of the inflation, and now they have to retract from some of that.
And now they're pivoting again, potentially. Another thing, if you're saying potentially there might be a world in which we would hike rates, that means that they're implying that these are not bumps in the road. This is a trend when it comes to fighting inflation, potentially.
A hot print story to start the year, 3 of them. 3 bumps in the road, if you want to call them that. We'll have that conversation in just a moment. Let's turn to the commodity board and look at crude, WTI and Brent as well. Pulling back by something like 1% so far this morning. We're down 9/10 on WTI, a break of 82 at 81.97. Under surveillance this morning, Israel retaliating against Iran following last week's missile and drone attack. Iran state media acknowledging the attack, saying the drone operation failed. Israel has yet to comment, and the details, I guess we're still pretty light on details at the moment, Anne-Marie, as we try and work out just what happened overnight.
I think the most important thing is whether or not this was a missile or a drone, where it hit. It's Isfahan. This is a place with a tremendous amount of capacity for how they build drones. They have Air Force Base here. It is also where they have nuclear facilities. So the message from Israel to Iran is, we know where your nuclear capability is, and we have the capacity to hit it. This is a warning, ready to take the temperature down, but we can do it if we feel the need to.
General Kim is going to be joining us in about 10 minutes' time to have this conversation about whether Israel has sufficiently demonstrated the capability it wanted to demonstrate with these strikes overnight. I want to talk about a single name. Check out Netflix, falling in the pre-market, the company adding more than 9 million subscribers in the first quarter. Sounds good, doesn't it? So why is the stock down 5%? It was almost double estimates, Bramo. It's the guidance going forward and the lack of disclosures, which our very own Geetha Ranganathan of Bloomberg Intelligence seems to suggest is responsible for a 5 percentage point move in the pre-market.
3 points here. First, Netflix was up 25% before this. So how high was the bar, and how little did the disappointment have to be to get this kind of move? Number 2, the fact that there is less of a focus on the expansion of subscribers and more on price increases speaks to where we are in this cycle, which I find fascinating. And number 3, they are not alone with that. The fact you can lump in Procter & Gamble talking about 6 consecutive years of price increases. I had to double check that. I couldn't believe it. That's what we're talking about, an additional 3% this year. This speaks to an inflationary moment that has not been killed off yet. I think that's fascinating.
The stock is down by 5.3% in the pre-market, looking at Netflix. Let's turn to the hawkish Fed speak. It's been ramping up over the last few days. Minneapolis Fed President Neil Kashkari saying they could hold rates steady all year. New York Fed President John Williams saying a rate hike is not his baseline, but leaving the door open if the data warrants it. Adam Posen of the Peterson Institute expecting a, quote, further secular rise in the US dollar against the other major currencies to get bigger over the next year, as the Fed will have reason to hold off cutting interest rates. Adam's with us here in Washington. Adam, good morning to you.
Welcome to Washington.
Thank you very much for having us, sir. Can we talk about the lack of cooperation and maybe even the complaints that you've heard this week about the strength of the US dollar? How loud are those complaints?
Well, after a long time of silence, even though the dollar kept rising, we saw yesterday Janet Yellen and her counterparts from Japan and Korea do an open mouth operation. Open mouth, sometimes stuff comes out, sometimes stuff doesn't. You know, there's very big fundamentals here. The Japanese economy is doing very well by its standards, and potentially could be raising rates, but it's not the U.S. Korea has a lot of positive fundamentals, but the point is, if even Japan and Korea are losing ground against the dollar, this is a wave. And my fear is it just goes up from here.
And their problems get bigger?
Political problems and economic problems. More political than economic, but yeah.
Can we talk about the political and the economic problems? First, the political. What would be the political problems that come about off the back of this move?
So it's probably not going to affect the election directly, but it sets things up for bigger trade deficits, which, again, is not necessarily a bad thing. But if Trump, as he stated, and Lighthizer view that as a real problem, or if over the course of the campaign the Biden administration starts talking about it and decides it's a real problem, then you have a need to deal with it. And tariffs, whatever their lack of virtues on their own merits, they don't fix trade deficits. That was demonstrated amply over the last 7 years. So you end up back in, if you care about the trade deficit, you care about the dollar, and most importantly, you care about what that does to credit conditions. So Lisa's rightly talking about monetary policy isn't as tight as the Fed thought. If you have a very strong dollar and money flowing into the dollar, that further loosens credit conditions.
You mentioned the fiscal deficit. The IMF pretty much put out a warning to the United States almost. It's too loose. We prepared to be looser this year because it's an election year, and there's no path forward for fiscal discipline. How much is the U.S. the biggest problem when you're talking to officials from around the world?
I mean, the U.S. is the biggest problem, Emery, mostly because of our unreliability in international commitments and the potential for unwinding even further those commitments, and a lot of self-dealing. So a lot of it's on the trade front, the security front, unreliability like with Ukraine funding, unreliability with trade deals with USMCA. But in terms of the dollar and the fiscal, I was glad to see the IMF getting loud, because sometimes they are scared to do real surveillance on China, US, the big economies. And, you know, we got open-ended fiscal problems. We've got this threat that by end of 2025, the 2017 tax cuts expire. So whoever's in Congress, whoever's in the White House has to make some deal. There's no historical precedent for letting tax cuts expire, as you well know, and then having them jump 7%. But the nature of that deal is almost certainly not going to include much tax increase. And without tax increase, I don't know how you get the budget deficit down.
You mentioned something. Let's go there. U.S. monetary policy. You wrote, it's not that tight at all. Are you saying that it needs to be significantly higher in terms of the benchmark rate in order to get inflation back down, even close to 2%?
I think it does have to be higher if you want to go to 2%. I'm actually calm with the Fed letting it stay roughly where it is and say it's a two-sided risk, as John Williams started to say. I'd be okay with that. But I do believe that the monetary conditions are not tight. Let me take you back, Lisa, a year ago, February, March, people like us, which is a funny category, but anyway, people
speak for yourself.
Fed nerds. We're talking about the fact that Fed had tightened, X hundred basis points, and it really wasn't affecting the economy that much. And then came SVB, and everybody got distracted. But if you go back to first quarter of 2023, that was the talk. And I kept saying, a few other people kept saying, look, credit conditions are what matter, not what the Fed funds rate. So John Williams, Lori Logan from Fed Dallas were coming out about 5 months ago, talking about, oh my God, there might be a recession because the interest rate goes up as inflation comes down. And I and a few other people kept saying, don't obsess with the Fed funds rate. Credit spreads are incredibly narrow. So anyway, it's less about the Fed has to do something different, because the numbers are okay unless you really care about getting to 2%. But the extent to which it's tight, I think, is way overestimated.
And you've been talking for a long time about how they need to have a higher target, even around 3%. So this coheres with that idea. We keep going back to the pivot, and we could talk about the pivot of the pivot and U-turn and all that, but let's not. I think there is a key question here of whether it was a policy error for Fed Chair Powell to enunciate the possibility and the likelihood of rate cuts this year back at the end of last.
I think it was. I think it was. I mean, it's a communications error, and it goes with, I think, two things that have generally been suboptimal, as we say. First, they're too busy trying to guide the markets in a decision-to-decision way, and second, they're too reactive to data. So if they had a bit more structure, they'd just say, we've gotten it to here. You can say, I'm data dependent, but you can say why you're data dependent, instead of just saying, I'm data dependent, but I think I'm going to do this.
Do the politics matter? Does the election matter? Could you give us some colour on that? Your impression of what people are saying here in Washington? Because you know what the story is in Wall Street. On Wall Street, there is a belief that there is this window in July,
right,
and if they don't go through it, that door slams shut, and it doesn't reopen until the end of the year.
Window for essentially all constructive, for a rate cut. Yeah, I think that's fair. I've been saying for a while, if they can avoid it, even when I thought they were going to cut in June, March, I never thought March, I always thought June. I thought they would try to avoid cutting again so close to the election. But I don't think that's big picture, really what matters. What matters is U.S. is essentially sidelined itself for the next year. We don't know what the fiscal policy is going to be. The monetary policy is on hold, which is reasonable, but therefore not reacting to things. And, foreign policy, which you all also cover, is, of course, dominating matters.
But there's so many unknowns then to 2025. How can the Fed do anything? If we get 60% blanket tariffs on Chinese imports and a 10% tariff wall for every single good coming into the United States, inflation may potentially skyrocket, which is what every economist is saying. How do you, as the Federal Reserve, then cut rates going into potentially that?
I completely agree with you, and I'm glad, Emery, you're saying that out there, because it is a true statement. Tariffs mean inflation, no matter how you cut it. And if you do broad across-the-board tariffs, even more than the anti-China tariffs, you're talking 1 to 2% jump in inflation almost immediately, and another percent probably, somewhere between 0.5% and 1% the next year, before you even get pass-on effects. So what does the Fed do? Now, of course, the Fed doesn't want to be seen as judging trade policy. So if this is a one-off, they can say, well, it's just a one-off. But they certainly should be saying that there's a risk of an upward spiral if you're putting that on top of inflation that's already above target, if you haven't changed your target, and it's already low unemployment. I agree. I mean, I think they should be warning about that.
So when you just take a step back and put all this together, there's a real question of how vulnerable the financial system is to some of the shocks that come from higher inflation and higher rates. We did speak yesterday with Jonathan Pingle of UBS, who talked about the potential for the Federal Reserve to raise rates to 6.5% next year if inflation stays above 3% in a persistent way throughout the rest of this year. What's the rate at which you start to see things break, both on the yield space side as well as on the dollar?
Here's where I'm probably more optimistic, Lisa. I think what we've seen over the last year, 2 years, is how much bank capital, household balance sheets, risk aversion matter, and the households having a lot of savings. So, we had much less breakage from these rate increases than we've had in the past. So I think talking to the financial and monetary officials who are in Washington this week, I think they're rightly, even though it's boring because they never do anything, talking about non-bank financial intermediaries, what we used to call shadow banks, because we don't have transparency into what part of the credit system is in there and how risky is it and how they reprice it. And so if I'm worried about something breaking, that's where I worry about it breaking. I think what we're talking about is potentially a further hike in the dollar, and that, going back to where we started, that is not sustainable long term. And then if you're busy having been annoying to all your allies and putting tariffs on them, it's a little hard to then say, oh, please do something cooperatively to bring down the dollar.
Yep. Can we finish on trade? It's been a theme of the programme over the last couple of days for us. Who in this city is left fighting for free trade? Who's leading that fight anymore?
I wouldn't say we're leading it, but the Peterson Institute's one of the only ones who are trying. We're trying to feed people the facts about what happens to American households, what happens to inflation, what happens to growth with the tariffs. The facts about, on the macro side, you're getting a stronger and stronger dollar, which is distortionary and which is going to overshoot. But if it's like 85, when you're putting tariffs on people, and also when you're not letting them invest in the U.S., you can't unwind this. Remember, in the mid-'80s, when everyone was so concerned about Japan, and the dollar shot up hugely because you had loose fiscal, tight money, so a lot of echoes of today. Part of the way we got out of it was we got the Plaza Accord. Yeah. But part of the way we got the Plaza Accord was also politically, Japanese and other foreign countries had their multinationals invest a lot in the U.S. So there's hundreds of thousands of Toyota and Honda workers now in the U.S. We're not letting the Chinese do that. So you're making it even more complicated to unwind this if we get into this mess.
It's a complicated mess already, some people might say. Adam, thank you so much for your time today. We appreciate it.
Thanks for having me.
Adam Posen of the Peterson Institute for International Economics on a whole range of issues. Equity futures continue to recover. We're down about 0.1% on the S&P 500. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Netflix crushed street expectations for subscribers, and yet shares are lower by more than 5% this morning. I caught up with CFRA's Ken Leone earlier on Bloomberg Brief, which you can watch every morning at 5 a.m., and he said that he's confused why the streamer would stop reporting subscriber metrics.
We're just perplexed. Why wouldn't you give subscriber numbers? They're just a little less confident. And don't want to surprise on the downside. The analysts are saying maybe this is a more mature company.
Maybe a more mature company, but as for the details, Netflix says it would stop reporting both paid quarterly membership and revenue per subscriber in the first quarter, starting in the first quarter of 2025. American Express beat earnings expectations, yet is down 1.6%. Revenue jumped in the first quarter 11%. Amex says it's still attracting high-spending, high-credit quality customers. Cards with a fee made up over 70% of their new accounts. 12 jurors and one alternative have been selected for Donald Trump's trial in New York. It's his first trial and the first ever criminal trial against a former president. Opening arguments in the case could start as soon as Monday. Trump faces 3 other criminal prosecutions. He's denied wrongdoing and claims the cases are part of a political witch hunt against him. That's your brief. John.
Danny, thank you. Up next on the program, Israel retaliates.
We're committed to Israel's security. We're also committed to de-escalating, to trying to bring this tension to a close.
A conversation just around the corner, live from Washington. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time, and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart, too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Live from Washington, good morning and welcome to the program. In the nation's capital for the IMF World Bank spring meetings. Equity futures right now negative by 0.2% on the S&P 500. Treasuries still steady, yields are lower by 3 basis points, 460.22. And even with some tension in the Middle East, we've got crude down by 0.5%, 82.34 on WTI. Under surveillance this morning, Israel retaliates.
We're committed to Israel's security. We're also committed to de-escalating, to trying to bring this tension to a close. You'll see soon in the G7 statement a commitment to hold Iran to account for its destabilizing activities, holding it to account by degrading its missile and drone capabilities.
Here's the latest this morning. Israel launching overnight airstrikes near Iran's third largest city. Iranian state media claiming nearby nuclear facilities are safe and saying the drone attack failed. Officials from both countries appearing to downplay the severity of the attack amid concerns over the risks of a wider conflict. Retired Army Brigadier General Mark Kimmich saying Iran, quote, does not have the capability for a response to an Israeli counter-response. General Kimmich, I'm pleased to say, is with us in Washington. General, good morning to you, sir.
Morning.
Do you believe, based on the reports that you've seen this morning and heard, that Israel has managed to at least convey superior capability to the Iranians?
Well, they've certainly displayed capability. I think the Israelis held back considerably. The fact that they could hit near Esfahan nuclear reactor, I think, was more of a message than it was a capability. And I think at this point, there's less chance of escalation than there was 24 hours ago.
Would you consider this episode closed?
My opinion doesn't matter. They've got to decide if this episode is closed. For me, it would appear what they're trying to do is go back to the status quo, which is a war in the shadows, not a war in the open that they've had ever since the assassination of the Quds Force officers inside of the Damascus embassy.
How do you go back to a status quo, though, when red lines have been absolutely evaporated this week, especially considering the fact that we had drones and missiles coming from Iranian soil to Israel? There's no red lines. It's all been pushed.
Yeah, I think that's a very good question, Anne-Marie. I think the fact that it appears one of the targets of the Iranian attack was the Dimona nuclear facility in Israel. And the fact that the Israelis went after a target near the Natanz nuclear reactors, which is the center of the Iranian programs, I think both of them have got to the cliff. They've looked over the edge, and perhaps this is a chance for them to pull back.
What do you make of what we've seen from the U.S. response, particularly when they said it was a massive success, and it was, in terms of their capability to shoot down all these missiles and drones that were heading towards Israel? Yeah. But the fact that it happened means that where was the deterrence from the West?
I think it's very surprising to see that the Iranians took the level of attack that they did to respond to the Syria targeting. We had not seen that before. That was far more than we had even seen after the targeting of Soleimani. By comparison, the Iranian response to the American operation against Soleimani was almost muted. We had a lot of soldiers get injured in that, but none were killed. But compared to the response against this recent incident in Syria, I think everybody is surprised. And at this point, everybody's trying to get the genie back into the bottle.
When you talk about the genie into the bottle, are you talking about Iran representing strength at a time where an attack that exceeded all previous ones ultimately failed?
That's the right way to put it. In many ways, Iran showed their weakness, not their strength, by doing this. But remember, they were not trying to achieve a military victory in this. What they were really trying to, the victory they were trying to win was a soft power victory, to show that they are the head of the axis of resistance, to show that they would not stand for what Israel did in a foreign country.
We're talking about the also coalition that was somewhat unprecedented of the U.S. and the U.K. and France, but also of Jordan and Saudi Arabia. Sure. How much was that sort of loosely cobbled together coalition on just this particular issue, almost contingent on a resolution to what's going on in Gaza?
Yeah, I think, first of all, it's important to understand that we have put together this coalition for over 2 decades now. It's been slow effort. We've tried to bring the entire region into a centralized air defense capability. the Abraham Accords took care of some of the political issues, the military issues are being worked out. I think that this demonstrates to the region why they want to work together more for the defense of the region, and both militarily and diplomatically. To me, this builds on the Abraham Accords, and I would certainly hope that this continues.
Well, for the Abraham Accords to continue, we really need to see Saudi Arabia and Israel sign a deal. And that can't happen without a resolution in Gaza, which I want to ask you about. Where does this leave Gaza, given the fact that we've kind of had this sideshow between Tehran and Jerusalem?
Yeah, I'm really glad you call it a sideshow because in many ways, Anne-Marie, it is a sideshow. Everybody seems to think it's the main effort, but no, it's the sideshow. I don't think that Prime Minister Netanyahu has slowed down one moment from his attack plans into Rafah. I think the real question is what happens the day after Rafah falls, the day after the Israelis declare that Hamas is no longer an effective fighting force and we've destroyed the infrastructure. Then the hard work of governance is going to come in, which we've talked about for quite some time. And until there's a solution on governance, there's really no solution on the two-state question.
General, we need a few more hours to complete this conversation. We don't have it. Thank you very much for joining us, sir. We appreciate it.
Thank you.
Thank you. That was retired Army Brigadier General Mark Kimmett there on the latest between Israel and Iran. Coming up in the next hour of Bloomberg Surveillance, we'll catch up with TPW's Jay Pilosky, US Trade Representative Catherine Tai, UniCredit's Eric Nielsen, and sitting down with the IMF First Deputy Managing Director, Geeta Gopinath. Bramo's going to run across to IMF HQ in the next couple of minutes.
Yeah, it wasn't gloomy enough for me today, so I've got to leave.
How gloomy are you going to make it with Geeta?
No, not at all. She actually wrote a brilliant paper that was really interesting, talking about what the fragmentation currently looks like, what that might mean about inflation, but we've been really wondering, what is the IMF's role in an era where so many people are rejecting the concept of free trade?
A lack of cooperation, backsliding into what Jay Pilosky has ultimately called a tripolar world. China, Europe, and ultimately the United States pushing forward with industrial policy, protectionism, tariffs, and subsidies.
So at this point, this is the bastion of free trade.
Yeah.
How do you deal with that?
I'm not sure if it is anymore. Equity futures on the S&P 500 negative by 0.1%. The third hour of Bloomberg Surveillance coming up next.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly, we want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale
and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
The basic fact is growth has surprised persistently, for the last year.
The U.S. is quite boomy right now. That does not seem like an economy that has restrictive monetary policy.
From just a growth perspective, we're exceeding expectations, but people are still nervous.
The question is, for the next 10, 15 years, is inflation at 2.5% or 3%? And the economy is perfectly fine with that and can continue to grow.
The U.S. is performing in an exceptional way. The question is, that sustainable or temporary?
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from the nation's capital here in Washington, D.C. for our audience worldwide. Good morning, good morning. The IMF World Bank spring meetings continue in D.C. Bramo's running off to IMF HQ. She's going to catch up with the first Deputy Managing Director, Geeta Gopinath. That interview taking place in about 45 minutes from now. If you want to know where the price action is, I can start with equities. Equities right now on the S&P 500, negative by 0.1% on the S&P, but the focus is in the commodity market, and crude is a lot lower, both on WTI and on Brent. We're negative here by 0.75%. Israel said it would respond, and based on reports we got overnight, they've responded.
Absolutely. What we've seen is a retaliation from Israel on Iran. And what's key here, Jonathan, is the fact that the city they struck, this is Isfahan, this is where there are nuclear facilities in Iran. So what Israel was trying to show was, okay, we're not trying to cause damage, but we are trying to send a message.
What is most instructive, though, in fact, informing perhaps West move in the commodity market this morning, is what they didn't hit, nuclear sites, and it's Iran's response to it, which at the moment is basically this failed and we don't need to respond to it.
And in Iran, they're not even, according to local press, having a national security committee, which means that they want to put this to the side, which means we do have a sense of de-escalation in the region at the moment, potentially a bow on this specific episode, which is the fact why we're seeing crude pull back, but doesn't mean that we could potentially not see skirmishes in the future, which is why maybe is almost a calm before a storm.
So earlier this morning we had two basic questions, and the first one was whether Israel had demonstrated superior capability to Iran. A lot of people would conclude perhaps they have. The second question would be, should this reinforce Israeli deterrence to Iran? Do you think it has, based on what we've seen?
I think given the city they've struck, potentially they are getting to that point. And I think Iran potentially really had this barrage, 300 missiles and drones, 99% of them were struck down. Israel sent a few to one specific city. It was a clear message that the Israelis were trying to send to the Iranians.
Brent crude down by 0.6%. Let's check out the price action for you. Starting with equities on the S&P 500. Equities negative by 0.1%. 5-day losing streak on the S&P could well become 6, but we're doing some work to make sure that doesn't happen. Yields are lower by 4 basis points on a 10-year, 459.19. Yields pulling back from the year-to-date highs struck over the last week or so. And as you move on WTI, we're back in the low 80s, heading towards another weekly loss on crude, $82 and down by 0.9 of 1%. Coming up this hour, we'll catch up with US Trade Representative Catherine Tai on Biden's 2024 trade agenda. UniCredit's Eric Nielsen on global central bank divergence, and Geeta Gopinath of the IMF on what she calls the risk of an economic Cold War. We begin with our top story. Markets on edge. The S&P heading for its third straight week of losses, but TPW's Jay Pawlowski remaining bullish, saying this: we remain happy to trade rate cuts for earnings growth. We are impressed at how well the equity market has moved ahead, shifting gears from the AI tech-led Magnificent Seven to a much more cyclical and commodity-driven advance. Jay, I'm pleased to say, is with us for more. Jay, here in Washington, D.C., you've heard it. They're talking about the tepid 20s over at the IMF. Have you got a different view on things?
Yes, John, very much so. I mean, the IMF meetings, historically, it's like Davos. You want to fade the consensus. A year ago, the IMF meetings were ultra gloomy, 100% view of recession. And guess what? Over the last 12 months, global equities up 18%, bonds represented by the AG down 4%. So yeah, we'll fade the tepid 20s, and we're more in the roaring 20s camp. And we wrote about this recently in the shape of things to come. Our view is that the 2023 to 2027 period globally is going to be very much like the 1995 to 1999 period in the U.S., which was a period of above-trend growth, better productivity, low inflation, real wage gains, in a pretty good environment for risk assets. We think the difference this time is it's going to be global.
What tells you, Jay, that it's going to be global? What's guiding that assessment at the moment?
Yeah, John, I mean, you touched on it, and thank you for the reference to our tripolar world thesis, which is now almost 15 years old. And it's funny, I've been thinking about it a lot over the last couple of weeks. And when we originally wrote up the thesis, it was the idea that each region, Europe, Asia, and the Americas, could self-finance, self-produce, and self-consume. And what we've seen, particularly over the last 5 years or so with COVID, is an acceleration of that process as supply chains regionalize, as the response to COVID, climate, and conflict drives spending. We've shifted from a monetary policy world to a fiscal-led policy world, to a point now where AI and the climate and EV revolution is really, fast-forwarding this process. And you can just see it by the AI companies in China raising money internally. You can see it, the same thing happening in Europe. President Biden's push for the CHIPS Act, Infrastructure Act, Inflation Reduction Act. We are in a period where even tariffs, you and Lisa talked about tariffs. Tariffs are forcing companies to produce in each region. You're having the Chinese coming to the U.S., producing EVs in the U.S. to avoid the tariffs. You're having the same thing happen in Europe. And so what you're doing is you're driving a period of investment in each region that is very much pro-growth. And the trade-off is, yes, we're probably going to have slightly higher inflation. And yes, we're going to have higher interest rates. But to us, that's not that bad a problem as long as we get the earnings growth that we anticipate. And by the way, consensus calls for 3 years, 24, 25, and 26, to have double-digit earnings growth in the U.S. Add to that buybacks, and you have an environment where I do think, the risk-reward for equities is pretty compelling.
So, Jay, you've offered us the framework, the way to think about the world. Let's talk about the vehicle to invest in. How would you approach this? What's the optimal way of expressing that in capital markets?
Yeah, again, John, thank you. It's right on point because I really am starting to think that investors really need to have a tripolar world kind of investment portfolio, meaning they need to be exposed to the growth opportunities that are manifesting in each region. And therefore, if you're U.S.-centric, you need to be looking elsewhere. And I'll give you a reference point. The IMF just put out its growth forecast for the next 5 years, and they noted that China is going to be responsible by itself, for about 25% of the global growth over the next 5 years. So you're telling me that as a global investor, you're not going to be invested in China, which represents 25% of the global growth over the next 5 years? You need to be invested there. And today is a wonderful opportunity to do so, given that Chinese assets are selling at massive discounts, particularly in things like the tech sector. So to us, one perfect example right now, very quickly, is you have a two tech stack divide in the world, a US-led one and a China-led one. China companies are going to dominate the China tech stack. It's multiples of the size of the US tech stack, selling at a 70% discount. We love that idea. Another idea is the AI revolution is going to require tons of energy. And therefore, we want to be exposed to both the semiconductor cycle and the commodity cycle. And then finally, to put a bow on all of this, is we want to be exposed to the emerging markets, which is a beneficiary historically of a global growth upswing. And again, it's been a tremendous laggard. So you are buying assets that are selling at 30 to 40-year lows versus the United States. And so those are just a handful of the opportunities that we see. We see lots of opportunities around the world, John.
Jay, you're in the same company as Ed Yardeni, who we spoke to yesterday. He had a 60% probability chance in the 1920s, 20% 1990s, but then there was another 20%, he said, that it could be the 1970s. How do you prepare a portfolio for downside risk if this was, say, the 1970s?
Yeah, no, Dr. Ed is, we're right in the same boat with him, and we think that's good company. We respect his work a lot. Look, I don't think it's anything like the 70s. I was just thinking about that when you were talking in the lead-in about what's going on in the Middle East, right? To me, the Middle East is the least important it's been in 50 years, right? In the 70s, the problem was the oil shock and oil prices quadrupled. That's not going to happen today. And here's a couple of reasons why it's not going to happen. One, most importantly, the U.S. is now the biggest oil producer in the world. Second is there are 5 to 6 million barrels of production capacity today that is on the sidelines in Saudi and elsewhere as they try to push the price up. And third, and perhaps most importantly, you have the EV revolution gradually eating away at fossil fuel demand as we see manifesting itself on almost a daily basis. And so I see the risk of a 70s type world being very minimal. Having said that, we do love commodities. Our asset allocation is we're overweight equities, we're overweight commodities, we're massively underweight fixed income. We have zero U.S. Treasury exposure. We haven't had any exposure for years because we're in this view of a stronger global growth environment than many expect.
I'll give you a call when we get back to 5%. I'll try and sell you some. Jay, it's good to hear from you. Jay Pawlowski at TPW. Jay, thank you, sir. It's interesting to hear that, as the Middle East is probably the most unstable it's been in years, to hear someone say it's the least significant from a commodity perspective in decades.
It's pretty shocking. Also, you have to think of the fact that there's cables underneath the Red Sea that can really hurt telecommunications. So I don't really buy into the fact that the Middle East is insignificant. Saudi Arabia, though, can also add millions of barrels right now to this market, and that would drastically change where we are in the oil price. So maybe it's not as important in the 1970s, but it's still very important.
Crude right now down by 0.7%. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Yields are lower, but the rally has faded throughout the morning with the ebb and flow of geopolitical risk. Mads Peterson of Human Edge Investment Technology told me earlier on Bloomberg Brief that now is one of the best opportunities in the past 10 years to buy bonds.
The U.S. Treasury at this level is starting to look extremely interesting. The whole curve looks good. It's probably the best time in a decade to use U.S. government bond as a long-time asset class diversification.
You can watch Bloomberg Brief every morning at 5 a.m. Eastern. Paramount shares up 7.5% in the pre-market after a report that Sony and Apollo are considering a joint bid for the company. Paramount is in exclusive talks with Skydance, but the proposal has generated significant investor pushback, according to the New York Times. Tesla shares lower in the pre-market trade 1 1/3%. It recalled almost 4,000 Cybertrucks to repair accelerator pedals that can dislodge, become trapped, and cause a vehicle to unintentionally accelerate. Tesla has told customers it will fix the pedals free of charge. That's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, Biden taking on China.
The Chinese government has poured state money into Chinese steel companies, pushing them to make so much steel as much as possible, subsidized by the Chinese government. They're not competing. They're cheating. They're cheating. And we've seen the damage here in America.
That conversation is coming up next, a special conversation with Catherine Tai, the U.S. Trade Representative. That's just around the corner. Live from Washington. Good morning.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Live from Washington, counting you down to the opening bell, about 1 hour and 14 minutes away. Equity futures on the S&P 500 shaping up as follows, almost erasing the losses of this morning. We're basically unchanged on the S&P. Yield still a little bit lower, down 4 basis points on a 10-year, 458.78. Under surveillance this morning, Biden taking on China.
America's still working out-compete as long as they have fair competition. But for too long, the Chinese government has poured state money into Chinese steel companies, pushing them to make so much steel as much as possible, subsidized by the Chinese government. They're not competing. They're cheating. They're cheating. And we've seen the damage here in America.
Here's the latest this morning. President Biden calling for higher tariffs on Chinese steel in a bid to shore up the U.S. steel sector. China slamming the potential restrictions, saying the U.S. is, quote, arbitrarily slapping tariffs on Chinese products. Ambassador Catherine Tai, U.S. Trade Representative, joins us now from New York. Ambassador, wonderful to have you with us on the program. We've done a role reversal. You're in New York and we're down in Washington. We'll make this work properly next time. Ambassador, this is a topic we've been talking about for a long, long time. Chinese overcapacity. We all know about the China shock. We all studied it. It obliterated manufacturing bases in places like the United States of America. Can I just give you a few minutes just to sort of lay the ground for us? What's changed and what's new about what's developing right now?
Well, I'd be delighted to. It's wonderful to be here with all of you. You're absolutely right about the China shock, and it's become an established set of facts as we look back on the last several decades of China's emergence as an economic powerhouse in the world. As you've seen the growth of the Chinese economy, what you've also seen is the negative impacts on other economies like that of the United States, and of course the industrial erosion that you've seen here. The manufacturing capacity loss isn't just limited to the United States. You see it in other advanced economies. You also see it in developing countries as well. But to your point, a lot of what we're seeing right now is not new. The China shock continues. We've seen it in the sectors steel and aluminum. We've seen it in solar panels. 20 years ago, the United States, several other countries had growing economies and industries around solar panels. The Chinese double down on their what we call non-market practices, their state investment in a strategic emerging sector. And what you've seen is something we've seen over and over again, creation of excess capacity, overproduction that brings down prices. It's a kind of predatory pricing practice worldwide that has driven out producers in other economies, leaving the Chinese economy having cornered the market in production. Right now, we're still 85% reliant on Chinese production and supply in solar panels. We've also seen it in batteries. We're seeing it now in EVs, and critical minerals is another example. So what you see us doing with respect to steel is actually responding to a set of pressures that have been building over a couple decades. On the steel point in particular, I wanted to really enforce that what you heard President Biden talk about earlier this week was to call on me as the U.S. trade representative to consider increasing the existing tariffs on Chinese steel imports. But we know that the challenge with Chinese overcapacity and excess production is a world economy challenge. The scale of the Chinese economy and its ability to manufacture and produce will depress prices worldwide. It infects the global economy and global prices. And so what you've seen is, as well, the maintenance of the global steel tariffs and aluminum tariffs, but you also see us as the Biden administration evolving out of that particular framework. You see us in particular taking leadership role with the European Union. Over the last 2 years, we have been engaged in intensive negotiations for a new framework, a global sustainable steel and aluminum agreement that we are working on to address not just the excess capacity pressures, but also to try to create incentives for cleaner production and cleaner trade in steel and aluminum.
So, Ambassador, if I can jump in, if we can focus just on steel, because we've got so much to unpack there. Let's take steel. And we both know how complex this is, and I can share some numbers with our audience, certainly not for your benefit. Direct Chinese imports, as you know, the estimate is something like 0.6% of total steel demand in the United States. The problem is, a lot of this is going through Mexico. So, Ambassador, a question I heard someone ask recently is, how do we make them eat it? So how can you address what is happening in Mexico? How do we stop the steel coming through the back door?
So I'm going to unpack this back at you in a couple ways. One is to reinforce the point that when you have a producer, a major dominant producer like China, producing at below market rates, it affects the entire supply chain, starting upstream all the way downstream. The Mexico challenge is a piece of this. And again, the challenge is worldwide. So I think with respect to Mexico, there are a couple pieces. One is to the extent that upstream steel is coming into Mexico and being worked on and then coming into the United States, you've got to figure out how to level the playing field there. Secondly, there's a much more blunt challenge with respect to steel coming into Mexico and improperly coming into the United States as Mexican steel. So there's a challenge with respect to the evasion of trade programs and trade frameworks where steel that's not properly Mexican is coming in as Mexican steel and enjoying the preferences that we provide to the Mexican economy and Mexican producers. So again, with respect to steel production, in order for the United States to continue to be able to produce, to continue to grow our steel industry, to continue to grow cleaner steel industries, what you see is a number of programs that we are putting in place to ensure the integrity of trade systems. The challenge right now is, and steel is an excellent example, that There is no such thing as free trade in steel. The market in steel globally is significantly distorted by what we are calling the non-market policies and practices coming out of China. Supply that's being created, production plans that are not linked to demand. And so what happens is you have a significant depression of prices, and it requires economies like the United States to work with other economies that want to be open, that want to openly trade, to take more significant defensive measures against the unfair practices that have infected this sector.
Ambassador Tai, do you see the similar dynamics in what you're describing in steel happening right now with the EV market?
100%. It's the same pattern that we see repeated over and over in different sectors. And the challenge for us is this has not been our practice. Largely, we have really adhered to this notion that if you just keep taking down barriers, if you just keep trying to trade more, if you just keep chasing efficiency, that everything will work out great. The challenge is that in every one of these sectors, we see that Chinese practices allow for Beijing to capture larger and larger shares of the global market so that you end up with a dominant producer in this entire economy. And what happens is the rest of us become extremely vulnerable and reliant on that supply. What we are trying to do is to find opportunities for us to defend, to stand up, so that we can restore more freedom to trade, more freedom to economy, more freedom for other economies to stand up to the coercion that results when you have these types of vulnerabilities that can be used to create political pressures on economies.
Well, the Biden administration made it very clear that tariffs on Chinese EVs, bigger tariffs, are coming down the pipeline. But Secretary Yellen also said the U.S., quote, won't take anything off the table when it comes to this overcapacity coming out of China. We, though, have not seen one single WTO complaint from the United States. Is that potentially a tool that you can use?
I wonder if you get your TPs, or your talking points, from my Republican senator counterparts from my hearing earlier this week. Look, the World Trade Organization is an incredibly important, valuable institution in the world. As part of the post-World War II Bretton Woods framework, the World Trade Organization is critical to the functioning of a modern world economy. That said, we also are very clear in our commitment to the WTO lies our commitment to reforming the WTO. I know this conversation is actually not unique to the WTO. All of the Bretton Woods institutions, the IMF, the World Bank, this is their week. In all of the conversations today, what you hear in all of those conversations is the question of how do these institutions evolve to meet the challenges that we're facing today. With respect to the WTO, that is also true. And in terms of WTO dispute settlement, we, as the United States, are very, very proud of our record with respect to challenging Chinese practices at the WTO. What we have found over time, however, is that each one of those cases that we bring, each victory that we score, ends up being a quite limited victory. It ends up in quite limited change. What we are dealing with in terms of the challenge of the Chinese economic system is structural. It's systemic. And so that's why we are bringing more strategy. We're bringing more creativity to look for more effective ways to level the playing field, working with other like-minded economies, and also working to raise these concerns inside of the WTO.
Ambassador, it's funny you bring up Republicans and their talking points, because broad strokes wise, what we see is that whether or not we get another Biden administration or Trump back into the White House, trade policies look almost the same when it comes to China. Do you see a divergence in what we potentially could see from Trump or Biden, given the fact that we still have Trump-era tariffs right now under this administration?
So I think what I will say is this, that whether it's Republicans or Democrats, going back to the earlier comments around the China shock, we are together, and I think that this also applies outside of the United States as well. We are coming to a realization and raising in our consciousness a common assessment with respect to diagnosing what the problem is, what the source of today's world economic and trade challenges is. Then you have to move on to what are you going to do about it? And with respect to the Biden administration, we are very proud of our record. First of all, the tariffs are an important tool in the trade toolbox, and that it is important to use them effectively and strategically and to know what the leverage is with respect to the tariffs. So yes, we continue to retain tariffs for strategic purposes. Second, the Biden administration hasn't rested on just trade or just tariffs to address the challenges that we face with respect to competing fairly with China. We have also, as you've seen, activated significant investments into the United States economy for the U.S. workers and for American infrastructure. It's the bipartisan infrastructure law, CHIPS and Science, the Inflation Reduction Act, the investments into the clean energy revolution. In addition to that, you also see that we have initiated an investigation into China's unfair non-market practices that have been alleged by 5 of our labor unions with respect to their maritime, logistics, and shipbuilding sectors. When you take these 3 segments together, what you have is the articulation of the Biden administration's China trade response.
Ambassador, I just want to ask you a question very quickly about Chinese EVs. Have you had a decision on that? Well, can we expect a conclusion anytime soon?
So I'm not quite sure. There's not a specific question before us. I think with respect to maritime logistics and shipbuilding, for instance, there is a petition that was presented to us. I think to your point, it's what are we going to do about this trend that we see repeating itself in the EV sector? Again, we have an entire set of tools before us. Many of them are with the U.S. Trade Representative, whether it's with respect to investigations that we can begin, whether it's looking at the set of tariffs that are enshrined in our tariff review, which has been ongoing for the last 18 months. With respect to that tariff review, I am confident that as a whole of government exercise that we have been undertaking with deliberation, seriousness, especially with respect to looking at more strategic, more effective deployment of the tariffs that we have to address the inequities in our trade relationship with China. I am confident that that conclusion will be coming soon.
Ambassador, can I just conclude with the following question? And it's probably difficult to answer directly, but the issues that you and I have discussed, that we've discussed over the last 10 minutes or so, as we started this conversation, they're not new. They've been at the forefront of many economists' minds for a long, long time. What strikes me as somewhat amusing is that it took someone like Donald Trump in 2016 to put them at the forefront of American politics, to shake the establishment, to almost make this consensus. And when I was listening to Secretary Yellen over the last few weeks, I just thought, this feels like a Secretary Yellen discovery tour, something personal to her, and nothing really new for policy. Ambassador, can I ask you, what took so long for the establishment in America to figure out this was the road they needed to go down?
Well, it's an excellent question because, you know, what I would do is I would actually have leaders in trade policy take ownership of the earliest calls for the need for attention to the challenges that we are all focused on now. These are issues that we have been raising at the WTO bilaterally with China very directly. For a very long time, we had direct dialogues with China where we would raise these issues over and over. We would raise them with our partners. I think part of what you see is the increasing pressure that is being placed on economic dynamics. One last point I wanted to make with respect to inflation. The inflation conversation gets attached to tariffs a lot. The more we are talking about inflation and examining our worldwide experience with this phenomenon over the last couple of years, the more we are realizing that inflationary pressures are linked to the supply challenges that we have. Those supply challenges go to our vulnerabilities, over-concentration, the domination that we see by certain producers in the world economy. I think that is the next area where we need to drive coalescence around our analysis so that we can work together, whether it's Democrats and Republicans, whether it's the United States and other countries, on solutions.
Ambassador, looking forward to having this conversation in person next time. Enjoy New York. Thank you so much for your time over the last 10 minutes or so. The US Trade Representative, Ambassador Catherine Tai there, on a whole range of trade issues. If you are just joining us, welcome to the program. We should probably kick it off with what's happening in the equity market. Equity futures on the S&P 500 just about turning positive moments ago. In the equity market on the NASDAQ, we're still negative by only 0.1%. The Russell just about unchanged on the small caps. If you switch up the board and turn to the bond market, we'll look at a 2-year, a 10-year, and a 30-year. The 2-year at the moment down 2 basis points, 496.43 on a 2-year maturity. On a 10-year, we're down 5 basis points to 457.96. Strikes overnight from Israel and Iran, according to reports. In the commodity market, though, no big move higher. We're down by 0.7% on Brent crude at 86.49. On WTI, we're down 0.6% at 82.21. Under surveillance this morning, our top stories: Israel launching a retaliatory strike on Iran following this weekend's missile and drone attack. Explosions were heard in Iran's third largest city. UN watchdogs saying nuclear facilities didn't sustain any damage. Elsewhere, Netflix reporting better than expected first quarter earnings. The streamer rebounding from a post-COVID slowdown. Netflix also saying it will stop reporting both paid quarterly membership and revenue per subscriber in the first quarter of 2025. That stock has been trading negative all morning and is down something like 5% at the moment. And finally, Apple bowing to Beijing's latest request, removing WhatsApp and Threads from its Chinese app store. In the United States, lawmakers trying to force China's ByteDance to sell TikTok. They're the latest protectionist measures by both countries. UniCredit's Eric Nielsen joined us now at the IMF World Bank spring meetings, where trade is very much at the top of the agenda. Eric, good morning to you.
Good morning.
It's good to see you. Let's talk about what's happening. And can you give us your impression of the tone of cooperation in Washington, D.C. with all of these protectionist spats ongoing?
It's terrible, right? I came to Washington thinking this is, we are on a slippery slope. It's getting worse. Maybe I was naive, but I've been stunned by how fast this thing is moving. And suddenly you hear senior people not longer talk about tariffs next year, but banning stuff, right? EVs, for example. So I'm starting to think, we are thinking as a Western analyst about where does the US go? How does Europe follow? And these sort of things. I think we have to start to think about how will China react to what we do, because we will do things now. It's pretty dramatic things, I fear.
And this used to be an economics forum, and you said recently it's sounding more and more like a national security forum.
Yeah.
How big a change is that over the last few years?
It's big, right? Let's remember, national security has always sort of been the big thing, right? Ultimately a country, this is the number one, right? But for 30, 40 years, we had an understanding and belief that globalization, economic openness, all these sort of things took care of it. Remember, Larry Summers once said, there's never been war between two countries with McDonald's, right? So the whole idea that if we sort of expand, we invest, it doesn't happen. That has changed now.
Russia happened.
Yeah. Well, Russia happened, right? So certainly within the last 2 years, the game has completely changed, right?
Do you think now we've moved on from a world where we're past peak free global trade?
Yeah, for sure. This is this I'm sure about. And what worries me more, if we always go in ways, what worries me more right now is we are in a vacuum where we don't know what regime we have, right? We've had all these years, the IMF sort of set the tone of macro thinking. We have WTO. I think with all respect, the ambassador saying they always work through the WTO. Well, America was not, always cooperative in the WTO. Let me put it this way. So I don't think it's fair to put blame just on one here, sure. But we can certainly observe that things are.
So where does this leave institutions like the IMF?
Where is it in the debate?
Where does this fragmentation leave them? Because it almost feels like they're steps behind what the countries are coming here discussing and concerned about.
Yeah, exactly. So this is economics and economic policy making has become secondary to national security. So the way I would put it, and a senior official said to me, a few years ago, when you met with the president in the sort of big strategy meetings, the first one who spoke was economic policy and then sort of things for her. Now it's national security. So my impression is that in the U.S., Jake Sullivan started by saying so and so, and then
everyone follows.
And then everyone follows. And when the economy says, well, this industrial policy and protectionism is not good, they say, we will do very little, but very high walls. But interconnectivity, why is it that Tesla cars in China, which are made in China, are not allowed into any parking lot near a government building. Because EVs have become data collection centers, right? Yeah. And I don't think we have fully got our head around this. And as it happens now, it's for us economists, it's problematic.
You've got to think about the economic outcomes. So, Eric, let's try and do that. This is clearly the direction of travel. Governments are known for their efficient allocation of resources. And I just wonder, what are the consequences of this massive industrial policy effort that's taking hold right now? What are they going to be? What does this look like 5 years down the road?
So, as you said, I mean, certainly less trade, home sourcing, friend sourcing.
Higher inflation, lower growth.
Yeah, so certainly lower growth and higher inflation. This is almost for sure. So less global growth. I mean, so it's not a surprise that the IMF has they have this sort of 3.5% global growth, which is a lot less than it used to be, right? So so I think we are, for the next 5 years, you're going to have lower growth. But it really, really depends on how the West reacts to this, and then, of course, how China and other countries react to us. So if we had an intelligent and coordinated for the Western world industrial policy idea to our thing, it's not all is lost, right? But the risk is that it sort of falls off, and the institutions are no longer playing a role in sort of getting people together. Yeah.
Eric, I was going to say enjoyed the last day in Washington, D.C., but it doesn't sound like you've enjoyed it at all.
No, maybe it's the weather. It's warm.
It is. I have been disappointed, right? I mean, it's problematic. It dominates the debate, and it should. But actually, I think it, as you sort of hinted at, it doesn't dominate the official debate, as far as I know. I mean, so it's seminars we talk about now, and we talk about environmental things. It's all important stuff, but it's sort of, we kind of have to anchor it together and see what. If this is the first thing that we have to understand, that globalization and free trade is gone, then we have to rethink as economists, where do we then take it, and how do we sort of, and we're not very good as a profession, we're not very good at reprogramming ourselves, right? I have
a feeling we'll be talking about exactly the same thing next spring when we meet each other again here in Washington. Eric, this was great. Thanks for having me. Eric Nielsen there of UniCredit. Up next on the programme, we'll catch up with the Santander chair, Anna Butin, and the IMF first Deputy Managing Director, Gita Gopinath. That's all coming up next on the programme.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Live from the nation's capital, good morning to you and welcome to the programme. Let's start with the price action in the equity market on the S&P 500 going into the opening bell. We've recovered. We were deeply negative. We were down more than 1%. We're now just about unchanged on the S&P. The rally in the bond market continues. We're down 3 or 4 basis points on a 10-year, 459.60. Under surveillance this morning, the Fed and ECB divided.
Growth in Europe has been mediocre and has been much slower than growth in the United States. But on both sides, you have an employment and a job market which is phenomenal. We are clearly seeing signs of recovery now, beginning timid and picking up in the course of 24.
Here's the latest this morning. The ECB and Federal Reserve on diverging paths. The ECB looking to cut rates as soon as this summer. In the United States, Fed officials are warning cuts may not come at all this year. Ana Botín is looking to navigate these challenges and more as chair of Banco Santander and the IIF. Anna joins us in Washington this morning. Anna, good morning to you.
Good morning.
Thank you so much for being with us today. We had a guest with us about 5 minutes ago. It was pretty depressing. Very downbeat on cooperation in Washington, the future for growth outside of the United States. How downbeat are you and your team about the same things?
Well, you know, first of all, we are at war. We have 2 wars, which is a human tragedy, and our thoughts are with all the people that are suffering. But aside from those very important issues, which obviously we must deal with first, the economy does not look bad. So, you know, we have managed to bring down inflation. Remember, we were around 9-10%. We were around 3-4% in most countries. Really important. That's the one thing we cannot allow to get out of control. We have growth. Yes, slower growth, but growth overall. And third, we have very high employment levels. If I think about Santander's Europe and America's footprint, every single one of our countries is at historically high levels of employment. So, you know, this is not bad. If a year ago you had asked many people where are we going to be, anybody that said soft landing, you would say, oh, you're being too optimistic. We have a super soft landing so far. So far, so good.
The growth profile is certainly much better than we thought it would be, not just 12 months ago, but maybe even 3 months ago. Though we still have 2 wars, we also have increased protectionism. It's been a key feature of the meetings this week, as you well know, a backslide towards industrial policy in places like the United States. Can I ask you, as someone who leads a bank, does that make it more difficult to be an international bank against that backdrop?
The key thing we're all looking to, and this is no different from what everybody is saying, is that the most difficult and the key risks now are geopolitical. As I said, the macro looks much better, at least for now. So as we think about what is happening and what these geopolitics mean for supply chains, for our business, understanding that this is going to mean more structural inflation because, you know, you're going to have higher cost. Understanding that you need to prioritize the defense or national security, or in the case of companies, you know, diversification, which again is a key asset, at least for us, and this is really very valuable. So these are the things you need to think about. How do I protect my business at the time when the world is increasingly volatile, where you're having a big shift in terms of we want secure supply chain. Yes, we want it to be affordable, good prices, but security is paramount. And of course, we also want to ensure that we can manage the green and the climate transition.
If geopolitical risks are your number one concern and that could potentially mean a spike in inflation, do you expect the ECB to then, what's been pretty much forecasted by everyone, go ahead of the Fed and have this rate cut in June?
So, you know, what we're thinking about is what is the terminal rate? Where does this end up? That is the key question. And our view, and as an institution, is that that terminal rate is not going to be the same in Europe as in the US. It's probably be around, if you talk to most economists, 4% in the US, around 3% in Europe. What it means is that, let's say, rates will end up around those levels, around 3%, 4%. And that is really that is what allows us to plan. Again, that is not a bad thing for commercial banks, for the sector. Negative rates were unsustainable, risky for the system. Very high rates kill the economy. You know, low rates, maybe we are going to have too low growth. And that is the one thing we need to focus on. How do we manage an economy where terminal rates are a bit higher because all the structural factors, not just defense, demographics, decarbonization.
True.
So you have structural trends that are more inflationary than before, slow growth. What do we do about it?
So I know that you're in a quiet period, so you can't talk directly about the financials, but can you help me understand, how do you plan for things like net interest income when you're across so many different regions with so many different policies and so many different so-called terminal rates? How do you plan for that kind of thing? What does that look like?
Look, Santander is a global bank, but basically it's Europe of the Americas. And we have 166 million customers. First thing is diversification is key, not just for us, for anybody. And we have diversification by businesses, 5 global businesses, and by regions and countries. So that means that if something doesn't go well in one country, usually it gets compensated by another. And so what you try is to really have a context for risk appetite. Do we take more risk, less risk? We don't manage interest rates, right? Yeah. As I said, the context is really good for financial institutions, especially commercial banks like ours. Why? Because negative rates meant that with a big retail base, you're not charged, but you were being charged by the central banks for 20% of our deposits, and we couldn't charge. So positive rates, low growth, high unemployment is not a bad scenario for commercial banks.
Some other banks have pulled back from the United States, international banks. I'm thinking specifically of HSBC, BNP Paribas are still there, they still have a presence. You've been leaning in a little bit more. Could you develop that for us this morning? What are you planning in the United States? How big is your presence going to be going forward from here?
We're very excited about the opportunities in the United States. We're very confident we'll reach the 15% return on tangible equity. And we're keeping it simple. Play to our strengths. Where do we have global scale that helps us in this market? Make sure that we are leveraging our network. And so in the biggest business, which is the consumer, we have something none of the other foreign banks have or had, which is at scale auto business. We're number 5 in the US. We're number 1 in Europe. We bring our OEMs here. And second, we have scale to invest in our own technology. So we're going to deploy our own technology to launch a digital bank to make sure we can fund the auto business competitively. Simple.
Anna, this was brilliant. I know you've got a super busy morning, so we appreciate you carving out some time for us here at Bloomberg. Thank you so much.
Great to be here.
Anna Botín there, the Banco Santander chairman. Let's go over to the IMF headquarters where Lisa's standing by with a special guest. Lisa, we're going to throw it over to you.
Thank you so much, John. I am here at the IMF headquarters with Geeta Gopinath, the first Deputy Managing Director for the IMF at a time of highly fraught geopolitical tensions, all this discussion about fragmentation. You wrote a paper that was fascinating about fragmentation, just how much of it is actually happening, the onshoring, nearshoring, reshoring, et cetera.
Yes. So, Lisa, if you look at the data and if you look at just a superficial number, which is the ratio of global trade to GDP. Now that number is holding up really well and you think everything looks fine. But if you look under the surface, you're absolutely seeing signs of fragmentation. And if you look at trade between a US-centric bloc versus a China-centric bloc, that trade has gone down by much more than trade within geopolitically aligned firms. That's also true for foreign direct investment. So we are seeing these shifts, but at the same time, we're also seeing the role of connector countries like Vietnam and Mexico that are coming in and re-channeling supply chains around the world. And all of this can raise the cost, ultimately, of goods for countries.
Which is really the key question here, which is how much structurally higher is inflation in this new era of fragmentation?
This is a main concern, and these are numbers that we have to determine. And now, we're still at an early stage, so we aren't looking at very dramatic movements over here. But if this process continues, it could lead to much more inflationary pressures.
Do you have a rate in mind about, is it 3% or 4%? Is that the kind of rate we can imagine in this world?
Right now, based on the scale at which it's happening, I wouldn't say it will be that large. But again, the risk is if it heads in a much more worse direction.
It seems like this is the path of travel. Everyone's talking about fragmentation. Everyone's talking about protectionist policies. In an era where so many countries seem to be rejecting free trade, what's the IMF's role?
We have a really important role to play as a multilateral institution. You know, the world is moving away from a rules-based trading system. So what needs to happen is diplomacy and pragmatic approaches. And that's what we're trying to push for through this meeting, getting countries together to work at least on areas where they can agree on, like on services trade. There's much more progress that's happening on services trade. We need to work together on debt issues, on climate issues. That will hopefully rebuild trust and slow the process of fragmentation.
We also see an increase in geopolitical tensions, and we saw this overnight with the attacks in Iran. There were some real questions about the possibility of an oil shock akin to the 1970s, with oil prices going to $100 a barrel, should this escalate. Do you foresee a similar type of thing happening?
This is a risk we worry about. If there is a serious escalation, which means a much more wider regional escalation than what we've seen so far, then yes, we could have a severe oil shock. But we're not there yet, and as you can see in terms of oil prices, it went up some, but it's come back down. We have supply excess capacity in Saudi Arabia. We have non-OPEC countries putting a lot more oil out on the market. So there are other sources of supply that can, buffer these shocks. But if there's a large-scale escalation in the Middle East, that is a problem.
Is that the line in the sand, $100 a barrel, and that would consist of the shock?
I think if going up $100 a barrel would be problematic, but even going from here to $100 a barrel would be difficult for countries to deal with, who are still fighting the last inflation fight, which is to bring inflation back down to target.
One thing that the IMF has talked extensively about is concern about sovereign debt, in particular in the United States and the overhang there. What's the outcome of that? Is the fear of some sort of slugflation or just sort of a sluggish growth kind of picture because of the overhang? Is it higher rates and potentially a Liz Truss moment, which I've been talking about and get shot down all the time in the U.S., but is there something like that that could potentially happen?
The U.S. is running very large deficits for a country where demand is very strong, and there is still the last mile in terms of bringing inflation down. So for all those reasons, the deficit, you can't have a deficit with 7% of GDP. It needs to be lower. And if you project out, it's going to stay at those high levels for a while. That has consequences, of course, for debt servicing in the U.S. But in a sense, the bigger problem is in terms of spillovers to the rest of the world. Because for the rest of the world, when you have so much of debt being issued by the U.S., that can crowd out the borrowing from other countries. Their cost of borrowing goes up, and their debt servicing costs go up by much more. So, I wouldn't say the U.S. has a debt sustainability problem now, but at the same time, when the U.S. is borrowing that heavily, that causes rates to be that much higher. It has implications for the rest of the world and for, corporations and households in the U.S.
How much higher? I mean, could you see rates staying here between 525 and 550 for the rest of this year, for even into next year?
That would not be our baseline. We would expect to see rates coming down. So, right now it's for getting inflation back to target. So we expect that will come down. It's going to take a little longer, but we expect that to come down. The question is whether it comes back down to what we saw in the decade after the GFC. And there, right now, that doesn't seem to be the case.
One thing that you talk about is this era of fragmentation is going to lead to a higher inflationary regime. Do you think it's appropriate for central banks to have a higher inflation target long-term as sort of their goal? Say not 2%, but 2.5%, or somewhere between 2 and 3%, just because it is a different reality now?
Yep. So firstly, that is a conversation we should not be having now. We need to ensure that inflation comes back down to 2%. Monetary policy can pin down a level of inflation. Yes, if you're going to have a lot of volatility in that inflation statistic, that could create problems because we are in a much more shock-prone world. But again, that is a conversation for later.
For later, but it might be.
Yes.
Okay. Gita Gopinath, I know, has to run, otherwise she will walk off the set because you have to get to a panel that you guys are hosting. It was wonderful to speak with you. Thank you so much, Gita.
Thank you so much.
John, back to you.
Lisa, great work. Thank you so much. Lisa Abramowitz there with the IMF First Deputy Managing Director, Gita Gopinath. Part of that conversation about fiscal sustainability, just to recap some of those headlines for you. The United States doesn't have a debt sustainability problem as of now. As of now is probably where the emphasis is right there and where it should be. The US cannot have a 7% of GDP deficit. It must come down. It's part of the problem here in Washington, D.C., and we've been having this conversation for the last couple of days. America is running a very large deficit, and that's part part of the reason why we're seeing this so-called US exceptionalism. And that US exceptionalism is coming with problems for the rest of the world. You don't just get the positive spillover from economic growth, you also get much higher interest rates, and with that, a much stronger dollar. And what you've heard over the last few days is complaint after complaint about what's developing in foreign exchange. And those complaints are coming from all over the place, including Malaysia, who have had to intervene, South Korea and Japan, who are stressing that they might do the very same. And South Korea and Japan, officials from both those countries, had a meeting earlier this week with the Treasury Secretary, Janet Yellen, and no doubt they were airing some of those concerns. Now, the big question for the IMF and the World Bank this week is whether that continues. How much longer will this go on for? The duration question is the one that's being asked in Washington, D.C., and none of us can give you an answer to it, because, AMH, the longer this goes on, the more problems that accumulate, the more stress that will build, and ultimately, words won't be enough from Japan and South Korea.
Absolutely. And Jonathan, you didn't just hear that from Gita. This was in their report. What I found interesting is they said, and don't expect this to be a quick remedy to what's going on in the fiscal policy in the United States, because also on the sidelines of the IMF, what everyone is talking about is the U.S. election. And the fact of the matter is, the United States is not going to spend less. There's not going to be tax hikes in an election year. So getting their fiscal policy under wraps to be a more healthy outlook, that's not going to happen this year, and it's definitely not going to happen in 2025, what Adam Posen said. The conversations will continue on Monday when we're back in New York City. Just to give you a feel for the lineup on Monday morning, Dean Kernan of Macro Risk Advisors will join us, Alcelios of RBC, JP Morgan's Bob Michael, and European Investment Bank President Nadia Calvino joining us around a table in New York. From Washington, D.C., thank you very much for being with us here at the IMF World Bank Spring Meetings. This was Bloomberg Surveillance.
From Washington to New York, to our viewers worldwide, a very good morning. I'm Manus Cranny filling in for Jonathan Farrow. The equity markets are grappling with more hawkish Fed speak and de-escalation from Israel on Iran. Is that the context? We'll count you down to the open right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up at the show, markets on edge over escalating tensions in the Middle East. Fed officials continue to push their higher for longer rhetoric. And stocks flirt with their worst week since October. This as Netflix misses the mark. The bar was high. We begin with the big issue. Geopolitical tensions, they're at the forefront.
First, the G7 condemned the unprecedented Iranian attack on Israel. Unprecedented in scope and scale. Scope because it was a direct attack on Israel from Iran. Scale because it involved more than 300 munitions, including ballistic missiles. We're committed to Israel's security. We're also committed to de-escalating, to trying to bring this tension to a close.
Well, Bloomberg's Anne-Marie Horton has been at the World Bank meetings throughout the past couple of days. She's in Washington, D.C., so we can certainly take the very immediate reaction. There was Blinken talking about this. From a market's perspective, Anne-Marie, talk me through the response from Israel to Iran. How well telegraphed was that? Were there warnings given? And the market seems to be reading this situation as a non-escalatory response. Good morning.
That's exactly right. You know, we've been hearing from Goldman Sachs, and they were talking about the fact that there's between $5 to $10 priced in the price of oil, but you won't see it escalate beyond that and go higher unless there was this retaliatory cycle. And right now what it does feel like is that this is contained. What you saw from Israel in terms of their retaliation on Iran, it went to a city called Isfahan. And this city is incredibly important because not only was it one of the areas where Iran fired off their missiles and drones to Israel last week and over the weekend, but this is a place where there's nuclear facilities. So Israel was sending a clear message. we can hit your nuclear facilities, we can stunt your nuclear capability, do not test us. And that is why you see the market start to ratchet this back down. In Iran, they're even downplaying this, and you don't even see a National Security Council meeting over in Tehran because of this. So it does feel like this could be the end of this specific episode. But clearly, overall, what you hear in conversations at the IMF in Washington, D.C., is that geopolitical issues in itself remain large. And I just see some headlines dropping on the terminal now that the United States is expanding the scope of their sanctions on Russia and Iran. But Matt, as you and I both know well, you can write down sanctions, but enforcing them is a completely different issue.
It is, and this has been the greatest accusation of all in regards to the oil cap price that was coordinated. Was it ever really that effective? Anthony Blinken says, again, Israel makes its decisions, and we have a commitment to defending it. I just wondered to what extent, Anne-Marie, this was Netanyahu calibrating to take consideration of Lord Cameron, along with the U.S., saying, you know, think with your heads, not with your hearts, and to this call behind the scenes for recalibration from the United States of America. I like what RBC Halima Croft had to write, which is, this is about the metastasization of this. We are not done with this geopolitical issue by a long chalk.
Right. This is just potentially the end of one little chapter we had. I would note two things. I think Netanyahu needed to show deterrence, but also wanted to show a little bit of restraint to put a little bit of a close on this specific chapter, because you had the very hawkish national security advisor in the Israeli government come out and in one word tweet in Hebrew say weak. So he wanted to see more. Yeah. So potentially you're seeing some of that restraint. And of course, the second thing is that at the same time this is happening, you have the U.S. Congress about to send over more aid to Israel, and the Wall Street Journal this morning reporting that the Biden administration is weighing another $1 billion when it comes to weapons to Israel. So even though they told Netanyahu, do not take the win, do not retaliate, they still seem like they are completely backing Israel.
Okay, Anne-Marie, thank you very much. Great work, you and the team. Over the past couple of days in Washington, joining me now is Terry Wiseman, Macquarie Group. Terry, good to see you this morning. We're just listening to Anne-Marie. We're trying to understand the calibration of markets' response to these actions by Israel. Your very first take on this, you talk about the axis of war and peace. You talk about the inverted smile. A bona fide peace without a war of attrition and without the threat of a wider regional war in our Mid-East would be disinflationary. I put it to you, Terry, it's a bit early to make that call that that's where we are.
Yeah, look, the point of what I was trying to say a few days ago is that if you are a bondholder, and this is specifically a view that pertains to bonds, not to FX, not to the stock market, but if you're a bondholder, you generally want to see two things. You generally want to see disinflation, because that will keep bond yields low and prices high for bonds. Or, you know, in a manner of speaking, you want to see a global conflagration. You want to see total war. Why? Because that's going to cause a flight into safety, out of risk assets, out of stocks, and the beneficiary of that is typically U.S. Treasury bonds, and then yields would fall and prices would rise. So those two extremes are generally good for bonds, and we saw a little bit of a flavor of that last night when you saw the first initial reports of the Israeli strike on Iran. While people didn't understand yet that this was a limited strike, but they thought it could lead to full-out war, bond prices did in fact rise, yields fell. But when we realized that this was limited war, that this is still in the confines of a shadow war, when global conflict generally these days takes place on borders, like you see in the case of Ukraine and Russia, those limited wars are not good for bondholders. All it does is keep the tension and expectations and the price premiums and things like oil high. That is not good for a bondholder, because you don't get the disinflation that you'd want to see if you are holding bonds. At the same time, you don't get the massive flight to quality out of stocks and into bonds that you would see with a much graver conflagration, much graver situation geopolitically. My point is that when you're in the middle between total peace and total war, you don't want to be holding bonds.
No, and you talk about this, the most sort of ill-fated place to be is the uncertain middle. We look at oil, I mean, I look at the price action yesterday in oil, $4. I look at bonds down 14 basis points, and there is this immediate volte-face this morning when we understand the nuances of the strike. Here we are kissing $90 on oil, and yet oil in of itself is not dislocating the bond market. At what stage does the price of oil really begin to kick into the bond market?
Look, the relationship is not necessarily linear, but I don't believe that the rally in the price of oil and gasoline in the U.S. over the last few weeks has had nothing to do with the rise in bond yields and maybe the suffering that we've seen in the equity market. To some extent it has, even though traders tend to associate an increase in oil with the non-core component of CPI and the PCE price index. I like to think that ultimately, if you get even what we've seen in terms of the increase in oil prices, it will have an effect on inflation. Put it this way. Fuel prices do enter into the general cost of business for sure, so they do have to raise prices on other things. But more importantly, when workers sit down with their bosses to negotiate wages, they don't say, they don't look at core inflation. They look at the things they need to buy, which includes food, which includes gasoline. So if headline inflation goes up but core doesn't, I think it can still have an indirect effect on core inflation down the road, simply by virtue of the fact that it increases wages, not just in the goods industry, but in the services industry, which are critical to core inflation. So I don't like this increase in the price of oil. I do think that it is ultimately something that the Fed could have to respond to. It's something that has been driving bond prices lower and yields higher. And it's as simple as that. Of course, if oil prices were to rise even further, on an escalation or expansion of this war to the rest of the region or to include the superpowers, of course, that would be inflationary as well. But keep in mind, like I said before, it would not necessarily be bad for bonds because at that point you could see that flight to quality.
Terry, what do you make of the past 48 hours of the descent in regards to the strength of the dollar around the world? And some would say the tacit acceptance by Secretary Yellen to allow the Japanese and the South Koreans to intervene. We don't know what shape and what form, but there is growing global dissent with the strength of the dollar.
Right, and central banks around the world are addressing this in two separate ways, two clear and distinct, but yet separate ways. One of them is the threat intervention. So we've seen that, for example, from Japan, from the BOJ. We've seen that from the BOK in Korea. We have seen outright intervention on the part of Malaysia. That's one way to address the problem. The other way to address the problem is not to talk about intervention and to talk about simply tightening monetary policy. Now, we've seen from a few of the emerging market central banks in the last few days. We've seen, for example, the rhetoric coming out of Brazil and Mexico from the officials at the IMF meetings talk in a more hawkish direction. Of course, some central banks might ultimately do both, right? Japan is a classic situation here where they could do both because they have a history of having intervened in the FX market. They did so in 2022 in the fourth quarter, for example. But they are also moving already in the direction of tighter monetary policies. In that case, you could easily conceive of the BOJ doing both to strengthen their hand. And it's one reason why I would not be a buyer of dollar-yen, let's say, at 155 here. I think that's a good target, but the skew is downward, i.e. towards conceivably a lower dollar-yen because of these threats.
Indeed. Well, history shows that unilateral intervention in of itself is usually folly and money ill spent. But when you're looking at a tripartite agreement with the U.S. driving the bus, it certainly can spook some of the dollar bulls on dollar yen. Terry, thank you very much. Stay with us. More to do. We're going to dig into some of the Fed speak. Joining me now ahead of the opening bell, it's Abigail Doolittle, side by side with the details. Abby, what have we got?
Well, Manus, right now we're looking at the possibility of a 6-down day in a row for the S&P 500. That would be the longest losing streak going back to October 2022. And one big weight is Netflix. Shares are down 6.9%. This after the massive first quarter beat, but it's not to last. The forecast for the current quarter relative to revenue, a bit tepid, disappointing. Plus, they will stop reporting subscriber numbers in 2025, given the fact that the stock was up basically 90% over the last year into today, investors selling it off. Trading down in sympathy, at least the last time I looked, to some degree. Microsoft, this will be one of the next big companies, tech companies, to report next Thursday. Actually, you can see not much of a reaction. More of a reaction from streaming competitor Disney, down 1%. And then take a look at Paramount Global, a content creator competitor, soaring up 8.9%, having nothing to do with Netflix, having everything to do with the speculation that Apollo and Sony may submit a joint bid for the media giant. We will, of course, be talking more about that, Manus, that possibility at the Open.
Okay, Abby, thank you very much. We're counting down to the Open. We're 18 minutes away. Coming up, sounds like higher for longer.
I'm of the view that things are going to be slow enough this year that we won't be in a position to reduce our rates until toward the end of the year.
Well, Fed officials see little urgency for rate cuts. The conversation next on Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Inflation is high, is too high, and we need to get it to our 2% target. The pathway to 2% is going to be slower than people expect, and it'll be bumpy. I'm of the view that things are going to be slow enough this year that we won't be in a position to reduce our rates until toward the end of the year.
Atlanta Fed President Raphael Bostic there signaling higher rates are here to stay. The hot U.S. economy drawing criticism from other countries around the world in Washington this week. German Finance Minister Christian Lindner saying earlier in the week, I don't want to be impolite. But if we look at the economic development in the U.S., the inflation rate is higher again, and this forces the Fed to react. For more now on the Fed and how it reacts, let's bring in Bloomberg's Liz McCormick. You know, Liz, there's a great saying, the road to hell is paved with good intentions, and the good intentions are we hope to be able to be cutting, but of course Bostic and Williams both fly the kite marginally of higher rates, but then dampen it down. Why fly that kite at all?
Well, I think, well, first of all, let's be fair to John Williams, who was asked that question, right? Manus, he was said, what, do you think you could see higher rates? So he has to answer. And he said something like possible. So, but I think you're right. The fact that, you know, he nodded to it's a possibility, and like you just played the clip of Bostic saying, you know, maybe not cuts till the end of the year. And I think he might have even flicked to maybe next year. I think, in fact, Chairman Powell on Tuesday at the conference in D.C. that he spoke at, he kind of said, not hikes, but kind of a stronger clarity on we could be higher for longer, kind of if inflation doesn't perform. So I think there's been a bit of a sea change and a nod to like, hey, we at the Fed are going to still, you know, make sure we do what we have to do. If inflation doesn't come down, we'll stay higher for longer. Or if we have to, they'll hike.
I know. Well, look, I suppose I latched on to the Williams thing because it really did spook markets. I think when they inject optionality to a hike, suddenly we become myopically obsessed that that door is open. But as you say, we need to be a little bit more controlled and contained. I love your article this morning. Everybody should go and read it because you get a nice little insight on the five-year forwards. Now, this is about the anchoring or the unanchoring of inflation expectations, and there are people out there that are concerned about the unanchoring or disanchoring of inflation expectations. Take me through the thesis.
Yeah, so the Fed has always, they've made clear that inflation expectations are important to them. They factor that into their thoughts when they're thinking about policy. And, you know, Chairman Powell has in the past nicely explained it. Like, the risk is that if inflation, it could go two-sided, but let's talk where we are now, that if people continue to think inflation's getting higher expectations, it could bleed into actual inflation. Now, right now, and they look at long run because there's a lot of noise in short run. So, yeah, and that article I was talking to Benson Durham, who's at Piper Sandler, but he was at the Fed, New York, and the board, very good wonky options guy. But he looks at long run, five-year forward inflation expectations, even kind of models them to splice out some other forces, say like liquidity premiums, and says, you know, they're too high. They're not screaming, you know, fire in a crowded theater right now, but they're too high. They're above the Fed's target, and the Fed will be, you know, that he thinks is what could really, his words, get the Fed's goat if they start to really unanchor. So that's on the radar of people. Like, you have to keep those contained. Of course, actual inflation has been troublesome 3 months in a row, hot CPI. So we'll see.
And this geopolitics and oil really take another leg higher, Liz. It can manifestly change the narrative as well. Great column. Encourage everybody to go and read it this morning. Liz McCormick on the bond markets. My guest this morning, Morgan Stanley's Dan Kelly. Macquarie's Terry Wiseman. Terry will be with me in just a moment. Dan Scully is with me. That's the beauty of live TV. Dan, good to see you in the end. Here we are.
Good to see you.
So I've just looked at bonds for the month. They're up 40 basis points. The bond market has aggressively repriced to a higher for longer narrative. I would say stocks have got away with it so far. Do I de-risk? Do I still have an option to protect myself? How do you look at the bond repricing relative to equity?
Yeah, excellent question and good morning. And I think it's a function of what you do within your allocation, right? And on that particular note, just this week, our Global Investment Committee, led by Lisa Shallett, made a couple of allocation changes to our outlook in terms of adding to larger cap equities, reducing small caps, and actually reducing some of our fixed income exposure on the duration side. And importantly, adding to real assets, right? So again, it's a question of staying invested here, yes, but mixing up the allocations within your portfolio to adjust to what's obviously a very fluid environment.
And that's what you basically say, net, this pullback is a healthy correction of overbought conditions. And the valuations are discounting an unreasonable rate of expectations. I mean, we haven't seen a major drawdown. We've seen a skirmish in these equity markets. We're going to go into earnings season aplenty next week. Netflix has its own tortured set of narrative in the past 24 hours. Procter & Gamble are raising prices. The stock is injured this morning somewhat. What are you expecting from earnings report next week that can create a solid floor in the equity market?
It's such a great question because next week is where the real fireworks, I think, could happen. You have 40% of the S&P reporting next week, inclusive of all those big tech names. The implied volatility and the implied one-day movement in S&P holding reactions on earnings this season is actually the highest it's been in over a decade. And so, look, our expectation is that many of the quality, scaled, strong free cash flow, still positive earnings revision type tech names can do fine.
Yeah.
We think, again, we are more cautious on some of the more lower quality, leveraged, smaller cap names. And so I guess the final thing I would say is, you know, this particular, you alluded to it, a skirmish, a mini correction off the March 28th high has been notable in that all of the first quarter leaders in tech, communication services, energy, have actually been the most defensive since the sell-off, which is telling us this isn't a real growth scare. It's not a real economic, cautious sell-off, because if it were, you'd be seeing the dividend and the defensive sectors like utilities, like staples doing better. So again, this is a pause that refreshes in our view.
Just very briefly, you also make it very clear. I mean, the SOX index is down, I think in the cash down 5.34 on the week. But you talk about a differentiation between owning bigger energy versus the semis and the industrial data the energy and the semiconductors that feed the data centers. You want to be longer a big energy relative to the semis.
For the moment, yes, but let's not deny the fact that some of the semis still have tremendous secular tailwinds. I think this is obviously a market that had gotten, over its skis in terms of cut expectations. Now that is adjusting. So some of those growthier assets and stocks are resetting. But longer term, we still like many of those exposures. And so, yes, it is a question about the long term versus the short term. I'd also want to just caveat, right, that when we think about a better economy, the inflationary environment, and you want to own some value, you want to own quality value, right? You want to own those names that still have good balance sheets and that in some cases are utilizing technology and actually in some instances utilizing AI themselves.
Dan, we got to cut it off there. Unfortunately, the clock has ticked against us. We count down to that earnings report sheet next week. Dan Skelly of Morgan Stanley on Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Let's get you your morning calls. First up, Canaccord downgrades Netflix to a hold, expecting a period of slower growth. Wolf Research upgrades Bank of America to outperform, seeing notable upside ahead. And Morgan Stanley upgrades Shopify to overweight, growing increasingly confident on its growth.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I want to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Equities are nervous as we go to the close of the week. The dominant theme is Fed speak, which is hawkish from Williams and Bostic in a relative sense to the geopolitical situation, which is being assessed at the moment as de-escalation. Do you trust that? These year markets were set for a dip as we start trading this Friday morning. The rest of your asset classes look a little bit like this. The dollar has had a heck of a run this week, both from a geopolitical aspect, but of course then this drop in yield that you've seen on the de-escalation risk in the Israel-Iran situation lets the dollar drift and the euro bid. 10 years down by 3 basis points. We dropped by 14 basis points yesterday. You saw this haven status of the bond market. We're at 4.6%. When will we possibly touch 5%? Does real money come in at these levels? Crude comes back to flat. We did spike higher yesterday on this retaliatory action from Israel to Iran. Right now, it is being assessed as a non-escalatory confrontation. Do you trust that narrative? There's one stock to watch, Netflix. The shares are moving sharply lower with the downbeat revenue forecast. Ed Ludlow is with me. I mean, the subscriber numbers were blowout, Ed, but it is about the guidance, and that's where the questions arise.
Yeah, anxiety on forecasts. The stock is down around 7%, putting it on track for its biggest drop since July, and trading at its lowest level since February of 2024. It was a strong quarter, right? They added 9.33 million net new subscribers or customers in the quarter, which was almost double what the street had estimated. And revenue growth or top-line growth of 15% was slightly above expectations. The guidance is that in the current period, that subscriber growth will slow, even though top-line growth of 16% would be a sequential quarter-on-quarter acceleration, but still below expectations, disappointing. It's a really interesting case study in corporate communication. We know what Netflix is and what it does, and they're saying that from 2025, we will stop reporting this quarterly subscriber gain or loss figure. And it is a figure that for all streaming platforms, investors have obsessed over. There is probably more philosophical debate to have about the value of it. Netflix management want the street to be focused on bog standard traditional financial metrics like the bottom line, how exciting. But if you consider the quarter just gone, 9.33 million new customers, the story behind that was that the password clampdown worked. In other words, users that had been password sharing or sharing accounts with family and friends had to sign up for their own account for the first time. And so contemporaneously, we had an understanding of what was happening. We know the content slate is strong. So if they're going to stop giving us this metric, there is some hangover and anxiety from the street about that. And what management said is, we will give you milestones when we hit big numbers along the way, but they're not buying it. The stock down more than 7%, biggest drop since July of last year. Happy Friday, Manus.
I hope you're not sharing your password, Ed Ludlow. That's all I'll say to you. Ed Ludlow there on the Netflix story. Let's stick with streaming. Shares of Paramount, they're surging as Apollo and Sony are said to be considering a joint offer for the media company. Here with a little bit more detail, it is Abigail Doolittle.
And that report, man, is coming as a bit of a relief because this stock down a lot over the last year. In fact, just this year alone, down 25%. There is a significant bearish short interest, so some of today could be a short squeeze. But yesterday, there was a report of exactly what you said, that Apollo is continuing a joint bid for Paramount, all shares, and they would be doing this with Apollo and Sony together. It could, if it were to happen, would likely assuage some of the financing concerns that Paramount management may have had with Apollo's prior $26 billion bid, given Sony's deep pockets. Basically makes Apollo more attractive when they come together with Sony. Now, there is, of course, the Skydance bid out there, but a lot of people thinking that that one might not go through or it wasn't necessarily well received. What is well received, especially given the fact that the stock is down so much, CDS on Paramount Global, senior CDS, have tightened 34 bips on this report, Manus, the most in 5 months, suggesting maybe there's some hope that this deal, again, right now it's just a report, speculation, but that maybe it will come to fruition and be successful.
Yeah, well, we have this changing media landscape. Abby, thank you very much. Abigail Doolittle on the stock moves. Let's turn to EVs. Never far from our heart is Tesla, pairing the earlier declines. This was following a recall of nearly 3,900. The Cybertruck, faulty pedals. Alex Semenova is with me. They just don't need this level of bad news on the Cybertruck, do they?
Indeed, Manus. Good morning. The troubles do just seem to keep piling up for Tesla. The EV maker received complaints from 2 customers related to this pedal malfunction. This is according to a recall report submitted to the U.S. National Highway Safety Administration. They say that when high force is applied to the Cybertruck's accelerator, the pedal may dislodge and get stuck, increasing the risk of a crash. Sounds quite dangerous there. That's resulted in the recall of nearly 4,000 vehicles. And of course, it's been a really challenging year for Tesla. Shares are moving higher after heavy selling this morning, but it's down about 40% this year. And earlier this month, the owner of a Cybertruck recorded a viral TikTok video where he described the accelerator pedal getting loose while he was driving, and he was stuck in full throttle. As of April 15th, Tesla said that it was not aware of any collisions, crashes, or death related to this. CEO Elon Musk on X said that they were just being extra cautious here. Manus.
Okay, well, it's a big week for Tesla next week, isn't it, in terms of the future on the Model 2 and other details. Alex, thank you very much. Alex Semenova. Turn over to the earnings season. American Express gains. This as revenue tops the estimates. Simone Foxman is with me, so we're spending on Amex.
Yeah, and especially consumers continue to flock towards Amex's premium cards. Fees from premium cards, cards with a fee accounted for 70% of new account acquisitions, a lot of those coming from Gen Z and millennials. Apparently markets like this, although this stock opened flat at the open. If you look through the financials that came out this morning, broadly, slightly better than expectations. We had revenue up 11% year on year. That was a slightly higher. Expenses slightly lower. And the firm set aside $1.3 billion for delinquencies. That's a tick higher year on year basis, but really in line with what the street had expected. And that allowed earnings per share to come in at $3.33, better than the estimate of $2.96, the company maintaining top and bottom line guidance. Amex says its high-end consumer that it really caters to is very strong, and it continues to remain strong. The CFO saying we're not seeing any softness at all in terms of demand for premium cards, reporting a 9% growth in spending, especially on airlines, especially in first class and business class. William Blair calls this a strong start to 2024, but they say that they're really waiting on an investor day that will be April 30th, Manus.
I still travel coach. Simone, thank you very
So
much.
do I.
Simone Foxman there with the very latest on American Express. Now, global markets are struggling to recalibrate and balance between the hawkish Fed speak from Williams and Bostic, as well as the Israeli retaliation against Iran. S&P 500 now tracking its biggest weekly decline since October. Joining me now with the view on the market, it is David Bianco, of CIO over at DWS. David, good to have you with us. So here we are. There's a number of different big themes at play. Do I just have to be strong, accept a higher for longer narrative and a higher inflation environment, and begin to adjust accordingly?
Well, that's right. I think they're not so much new issues, just we're getting a little bit more clarity on these issues, and things aren't working out quite as the biggest optimists or biggest bulls had expected. I think what we're seeing this week I think it's setting the tone for the summer, and I think it will be a soft summer for markets. I think the S&P 500 is going to work its way below 5,000, kind of settle in a 4,700 to 5,000 trading range up until the election. And the reasons at this stage, it's becoming pretty obvious. The Fed's going to have to wait longer before they begin cutting, and we'll even find out how much they eventually cut. And the geopolitical situation we know is still running hot. And the valuation at the S&P 500, particularly against these interest rates, and just a 20.5 PE multiple on this year's earnings estimates, this is still an expensive PE, and that's why next week, where about 40% of earnings are reported, the beats need to be big. The beats really need to be over 5% on average for us to have any, continued confidence that the $243 that we and the street are estimating are really achieved, because those estimates for the year are back-end loaded with a lot of growth coming in the third and especially fourth quarter of this year.
Where is the biggest susceptibility to disappointment on what you need to create the floor? We're at the money now at the moment. We're at the money at 5,000. So next week could be pivotal to open up the trapdoor to 4750. So where's the susceptibility in this reporting season?
Well, there are two key parts of the S&P 500, and each of those parts has their own susceptibilities. The 492 S&P 500 index stocks that are not the grade 8 digital type names, they're susceptible to a further increase in interest rates, and I would argue their PEs at about 18.5 on average are very high versus a 4.6% 10-year Treasury yield or 2.2% 10-year TIPS yield. So the 492 is at risk to these and higher interest rates. And when we look at the earnings that are coming from those companies, particularly ex-financials, there are some green shoots of improved earnings growth. But if those companies don't beat by at least 5%, then there'll be flat earnings growth year on year again for the S&P 492. So, I mean, there are pockets of strength, industrials, there are pockets of weakness, energy and others, but this is really sluggish earnings growth outside of the grade 8, and at these interest rates, that's a concern.
I always feel like
the other part of the market, the other part of the market's the grade 8, and they have to just deliver tremendous earnings growth and very optimistic outlooks and continue to disclose all the data they can on their operations to keep investors confident and very exuberant about the long-term view.
And keep them on side. I always read the fund manager survey from Bank of America, and I always feel like I'm the poor retail victim left at the back of the bus, that forgot to get off at the right stop. Big money, institutional money, smart money, as I've written down here, $21 billion flowed out in the last 2 weeks, the biggest outflow since 2022. And yet the fund manager survey is the most bullish since January 2022. What do you see in terms of flow? Are the retail like me left on this bus at the moment, vulnerable to a material drawdown when institutional flow is taking money out?
Well, I think when you look at different investor types, big money, institutional money has an asset allocation type mindset. And big money is definitely noticing the attractive risk-adjusted opportunity being provided by bonds right now.
Yeah.
Short duration, but also inflation-protected longer bonds, and that just cannot be denied by those who have to make and do make decisions across asset classes. I think they're going to use these short-term interest rates to see how things play out and take a little and further risk off the table. I would argue that retail investors, where we have seen signs of their risk appetite cooling a bit, they are still confident in the AI story. But I think those type of investors also need to be a little bit more appreciative of valuations, and that not every company is going to be a winner in the end, and competition will heat up in that space, particularly semiconductors.
Yeah, well, I mean, I had the Norwegian Sovereign Wealth Fund with myself and Danny just the other day, and they are cautious about the valuations in tech, and not so much that monetization can't happen, it's just how quickly it can happen in the AI space and the timeline to that margin. You talk about financials, we talk about this higher for longer narrative, you talk about the valuations not exactly being stretched. We've just gone through the reporting with JP Morgan, with Wells Fargo, with Goldman Sachs, etc. Differentiate for me now on financials in terms of whether you want to be in regionals, whether you believe the CRE is past, or whether you want to be on the big beasts.
So let me start by saying we are a little cautious on markets going into the summer before the election, and financials are clearly higher beta stocks. But those who are more optimistic and those who are looking to make plans for where to act upon a dip, we would point out big financials, big banks, big insurance, big asset managers, big brokers, big exchanges. And the results that are coming out of these companies are good, and capital markets activity is good and has potential to further accelerate. But I think big is the key theme when it comes to financials. These big institutions have the deposit base, they've got the confidence of those who buy their securities, and they are the ones in the position to continue to invest in technology, AI productivity. I'm really afraid that smaller banks and smaller financials in general are going to fall behind, be left behind. We know the challenges at regional banks. I don't want to overly beat up on them because those valuations are beaten up, but I would stick with the big banks. I would stick with the big financials.
Big is beautiful.
And for those who've been arguing, yeah,
big is beautiful. David, we got to leave it there. We got to leave it there. You're right. Hunker down for 16.
See you next Friday.
See you next Friday. $16 trillion worth of reporting on the markets next week. David Bianco there of DWS, my guest on the markets. Coming up, Netflix stopping subscriber numbers.
We're just perplexed. Why would you give subscriber numbers? They're just a little less confident and don't want to surprise on the downside. The analysts are saying maybe this is a more mature company.
We'll continue the conversation on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will
this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
We're just perplexed. Why wouldn't you give subscriber numbers? They're just a little less confident and don't want to surprise on the downside. The analysts are saying maybe this is a more mature company.
Let's set the stage. Netflix posts its best start to the year since 2020. 9.33 million subscribers. But the celebration was short-lived. The streamer announcing it will stop reporting quarterly subscriber numbers. How injurious is that? Geeta Raghunathan joins me now from Bloomberg Intelligence. Do you think that's really the reason why the market is so irked? They still say that they will give us milestones, Geeta. They had a pretty strong subscriber growth, double what the original estimates were just a few weeks ago. Is that the flesh wound we're suffering this morning from? This scare to guidance?
Yeah, it most certainly is, Manus. I mean, that was a very, very high quality first quarter earnings report. There's no doubt about it. They outperformed on all the metrics that we were looking at. Guidance also came in pretty much in line, but I think this whole point of them going to stop their subscriber as well as their ARPU disclosures starting in the first quarter of 2025 has really kind of spooked investors. But it really tells us is that, you know, maybe the company is entering this more mature phase and maybe, you know, subscriber growth is going to peak this year and it is going to start decelerate. And obviously they want to reduce the volatility around that reporting of subscriber metrics.
I'm looking at your most recent note. It's a no house of cards, to quote you, not me. 27 times forward earnings. Where does that rank relative to other streamers? And is that the disconcerting part of this narrative, which is if I look at Netflix on a relative basis to its other peers in this space, the numbers are not strong enough?
Yeah, so that is the question, right? Should Netflix be valued like a media company or should it be valued like a tech company? So if you kind of looked at where Netflix was trading before yesterday's earnings report, about 27 times forward EBITDA, that's double of where its closest peer on the media side, Disney, is trading, right? Disney is at about 13 times forward EBITDA. Again, you could, but then again, you compare it to some of the other, you know, the TV media peers like a Warner Brothers or a Paramount or a Fox, it's almost 4 times, you know, that EBITDA multiple. So obviously there's this huge delta. I would say Netflix justifies that multiple. And I would say that just based on their profitability metrics, Manus, because you kind of look at what they've been able to achieve. Obviously, they have that first mover advantage in streaming, but then you look at some of their operating income metrics, $7.5 billion in profits last year, close to almost $9 billion is what we're expecting this year. Free cash flow has been on a tear. And then you look at their margins, right? And this has been the perennial question in media. Can Netflix ever replicate the old media model where you had these TV companies throwing off about 30% 25% margins, and Netflix shows that they're already hitting 25% this year. They probably are going to get to 30% in the next couple of years' time, and maybe even more than that. Maybe we're going to see them get to like 35, 40%. There's a lot of operating leverage in the model when you have scale, and Netflix is showing us how it's done.
Okay, well, it's certainly a juggernaut, isn't it, in terms of valuation, and you lay the landscape very clearly in terms of the acceleration of margin expansion rather than headwind. Geeta, thank you so much, Geeta Raghunathan there of Bloomberg Intelligence on your Netflix movers. Let's get to Abigail Doolittle. She's got the other sector price action to wrap up the week.
Well, we are looking at something that we have not seen since October of 2022, right now at least, the possibility of 6 down days for the S&P 500 in a row. Not surprisingly, communication services, which Netflix is a part of, the worst sector on the day, down 1.3%, taking the other two mega cap tech sectors with it to the upside. Energy, but up just 0.8%, unable at this point at least to outweigh some of that point drag from mega cap tech and Netflix in particular. As for the week, as you've been mentioning all morning, Manus, we are looking at the worst week potentially since October of last year. Most sectors are lowered. The worst sectors are in part some of those mega cap tech sectors, including the tech index down 4.9%, having a lot to do with some of that chip weakness. Real estate also lower, down 3.7%, having to do with yields being higher. The dividends look less positive. Of course, rising yields not positive for the real estate sector. Then there's discretionary, Tesla a weight there. Energy, despite today's gain, well, it's down 1.5%. A little bit of a rough week here for stock investors.
Yep, it's certainly been one of the toughest weeks for quite a while. Abby, thank you very much. We're struggling with higher rates, volatility on the geopolitical front. Coming up, we'll give you the market moving events to close off your week and set your trading diary on Bloomberg.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity markets really are struggling with geopolitics and Fed speak. Netflix, are you sharing your password? That's not what's dragging Netflix lower this morning, but it is having weight on the NASDAQ. What's dragging it lower is about valuations. It's had a cracking run. They're not going to disclose subscriber growth. Keep an eye on NVIDIA. Look, it's a bellwether for, I suppose, confidence. It's also taking a bit of a hit this morning. We're going to wrap up the week for you. Stocks are really trying to steady themselves for now. This is what you need to know for your trading diary for next week. Fed President Austin Goolsbee speaking at 10:30 a.m. Eastern. And moving to next week, Tesla results are out. More from IBM, Meta, Boeing report on Wednesday, Alphabet, Microsoft on Thursday, and Unmatched on Friday.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time, I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Great World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. Alex Steele on day one of vacation, somewhere down on some island down in the Caribbean, I'm thinking. So good for her. So Danny Berger sitting in for Alex for an hour, right? We got you for an hour.
Yeah, got me for an hour.
Awesome.
But now that you said the warm weather,
I know.
I'm happy to be here with you, Paul, but feeling jealous this morning.
Exactly right. She's down having a good time. So we got a lot coming up in the next couple hours. Bloomberg Intelligence. We focus on companies, stocks, bonds, that kind of thing, and we lean heavily on the over 400 investment professionals at Bloomberg Intelligence. Starting off, we're going to check in with Ethan Bronner. He's a Bloomberg Israel Bureau Chief. Get the latest on the escalation of tensions between Israel and Iran. And then Geetha Ranganathan, she covers all the media stocks for Bloomberg Intelligence. She's going to join us on Netflix. I thought they had a great quarter last night. Stocks trading down. We'll figure out what's going on there. But first, let's kick everything off this hour with Lisa Mateo. Any Bloomberg Business Flash?
You got it. Market Drivers brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. All right, before the bell, futures were under pressure due to tension in the Middle East, but Iranian media, it appeared to downplay the impact of Israeli strikes. So now we have stocks mixed. We have the NASDAQ down 0.4%, the Dow down, the Dow up about 0.4%. The S&P 500 is little changed. The 2-year yield at 4.98%, that's little change. The 10-year yield at 4.61%, and that's down 2 basis points. Over to commodities, we have Brent crude, $86 a barrel. NYMEX crude at $82 a barrel. Spot gold higher at $2,380 an ounce. Want to point out Bitcoin up 2% at $64,987. And this comes ahead of Bitcoin halving due to begin later this evening. That is your Bloomberg Business Flash. Back to you.
I'm not sure what I really understand Bitcoin halving, but I think it just means less supply coming on the market, which is bullish, presumably. Is that your understanding, Danny?
That is my understanding, but I've read lots of reports that it would not be bullish for it because it also means less mining. Historically, it's been bullish. Just to add to the confusion, Paul,
Exactly.
just to make sure that nothing's clear.
This is my Bitcoin call, and I learned it from Mike McGlone like 10 years ago. Limited supply, and presumably greater and greater use cases pushing up demand. Fixed supply, higher demand, it's got to go up.
Yeah.
That's my call, and that's my cocktail, basically knowledge. So if you come up to me at a cocktail party, what do you think about Bitcoin? That's my response. That's all I got.
That's good. My response is usually worse than that. I'm like, well, I know it's used to do crime sometimes.
Okay.
Which is, you know, yours is a much more PC response, I think, Paul.
All right, very good. So we got Danny Berger, Bloomberg Television, sitting in for Alex Steele here for the next hour. So that is a good and wonderful thing. We got lots coming up here. Let's check in on these markets here. Again, as Lisa was just reporting, kind of some red and green on the screen here, but Abigail Doolittle, she looks under the hood, sees where things are happening with these markets. Abigail, what are you looking at?
I am looking at the stock that I think everybody's looking at this morning. Netflix shares down nearly 6% off of the lows, but nonetheless the worst day since July, I think, of last year. At the lows, it had been the worst day since July of 2022. And this, of course, after they put up a blowout quarter, but the guidance for this current quarter, the revenue guidance, a little bit light. And then they're also talking about ending, they're not talking about, they are going to end the subscriber count in 2025. I think that's giving some folks less confidence in their subscriber numbers going forward. That's speculation, of course, on the part, but it's understandable since they've given it for such a long time. And on this right now, we have the S&P 500 down slightly. If it stays down, it will be a 6th down day in a row, and that would be the longest losing streak since October of 2022. So the bears gaining some ground on this Netflix guidance issue.
On the other side, though, there's Paramount gaining a healthy amount this morning, almost 10%. What's going on there, Abby?
Yeah, it is a nice gain there for Paramount for sure. And it's been up over the last 3 days, despite the fact that the market's been down, up more than 10% at one point, the best 3 days, going all the way back to November of last year. And this on the possibility of an Apollo-Sony joint bid for Paramount. This would be a relief to investors in some ways, potentially, some analysts are saying, because Apollo's previous $26 billion bid apparently was a little bit less attractive because it didn't have big financial backing, but now having Sony Entertainment behind it to buy all of those shares, it's positive. And it's not just showing in the stock. Now, I should say the stock's pretty beaten down, but it's also showing in the CDS. They've narrowed 34 bips, the most since 5 months. So investors across the capital structure signaling some degree of enthusiasm that maybe we'll actually see a deal get done. And of course, that ByteDance bid is out there, but I think not a lot of support for that one.
Back in the day, I could have sold this company with 2 or 3 phone calls for 4 or 5x what they're talking about these days. It's just amazing what's happened, unfortunately, to this company here. Hey, Abigail, looking at the S&P 500, I've kind of got, I don't know, almost a 5% drawdown, as the kids like to call it. I call it a sell-off.
Yeah, I'm with you, Paul.
Is that enough? Is that meaningful? Is 5% meaningful, or is it just kind of no big deal?
Meaningful in what regard?
Like you know, a lot of folks have been saying, hey, for this long-term health of this market, we do need to see some meaningful drawdowns in this market from time to time. I mean, we really haven't had it. Nothing more than 2%, really. So is this something that gets your attention?
You know, 5% not really, only because the rally up was so significant. That rally out of the October lows of last year, up 30%, and much more so from the October 2022 lows. In addition, we have that S&P 500 through its 50-day moving average, which is starting to flatten that. That tells you the dip buyers are basically gone. The 100-day moving average is coming up next. That's another level of support. But one reason to think we go even lower is the Russell 2000's almost on its 200-day moving average. So it's unlikely that you're going to have those two indexes diverge for too long. And plus, if you take a look at the Russell 2000 over the last summer, it crossed below its 200-day moving average much faster than the S&P 500. And again, pointing to, and then the S&P 500 did follow, pointing to something similar here. If that happens, I received some social media banter yesterday saying that I casually call for 4,700 on the S&P 500, but that's where that 200-day moving average is, and it seems likely. So yeah, I think it's going to be more than 5%. I don't think 5% is meaningful enough in terms of healthy consolidation for the S&P 500 or the other indexes.
Abby, it did seem, though, that 5% used to be enough.
Yeah.
It used to be enough to buy the dip because we just kept going higher. This does feel like a sentiment shift of some sort.
Well, it's different from the standpoint, the 5% dip buying that you would have before. You had the Fed Fed support from the standpoint of various levels and ranges of QE and other kinds of accommodation. At this point, not only do we not have QE, but we also have the likelihood that the Fed's not going to be cutting the 6 times that people thought last year. They might not even be cutting the 3 times the Fed had said earlier this year. And who knows if they even cut the 2 times that we now have warp and swaps pricing in, given the fact that there's hot inflation data out there. So market investors really don't have the support of the Fed and the liquidity right now from that standpoint. So I think that that's why 5% from a fundamental standpoint may not be enough. But let's see the rest of earnings too. I don't think that earnings could overweigh the Fed, but you never know.
Yeah, a lot of folks are saying you do need to focus on earnings because we kind of have a sense that the Fed's not going to be real aggressive. So if there's going to be any support or a leg higher, it's going to have to be earnings driven. So we'll see how that comes in. Abigail Doolittle, thank you so much for joining us. Abigail Doolittle, she covers all the markets for Bloomberg, and we appreciate getting a few minutes of her time. Of course, the geopolitical issues globally are back on the forefront here overnight. Israel retaliatory strike on Iran last night. Many folks calling it a measured response. Maybe proportionate, if you will. I'm not sure how you define all that. I guess that's different for everyone. But let's check in with someone with feet on the ground, Ethan Bronner. He's the Israel Bureau Chief and Senior Mideast Editor for Bloomberg News. He joins us from Tel Aviv via Zoom. Ethan, what's the feeling on the ground in Tel Aviv today as it relates to Israel's strike on Iran last night?
I think you described it well. I think that the view here is that what Israel did was to sort of smack at Iran at a place that says we can get to you. Where it hit was at one of the air bases from which last weekend's attack came, and also not far from nuclear sites. So the Israelis, their attitude, at least their claim, I'd say the mainstream claim, is that we hit back in a way that said, we want you to know that we can do this and we're not going any further, and let's stop this here. There are those who are very upset that it wasn't sufficient. There are those who wanted nothing to happen. But I would say that, it is not being criticized too heavily except from the far right now.
Yeah, Ben Gvir, the hawkish national security minister in Israel, tweeting just one word: weak.
Right. That word was a Hebrew word for meaning more like lame or wimpy. Yeah. Very, very critical.
That one word doing a lot of work here to suggest that not everyone is in agreement. And at the end of the day, Ethan, this is a big change from going Israel and Iran in the shadows fighting to now out in the open and out in open conflict. So while markets are treating it as if it's over, this is a shift, isn't it?
It's a shift. Of course, it's in many ways a shift that began not by Israel this week, but by Iran last week. That was the beginning of the big shift. Israel has been hitting on occasion inside Iran. No one's kind of acknowledged it, but 2 or 3 occasions, and where with missiles and and drones, and other occasions where they have assassinated Iranian nuclear scientists and so forth. But the big change began last Saturday night when Iran said, "Okay, all of this stuff you guys are doing to us, both of our proxies in Iraq, Syria, Lebanon, and so forth, and now us, we're coming back at you directly." That was the change. And now Israel hitting back, saying we can't let this happen without some response. The whole debate is, should there have been a response? All week, the Americans, the French, the Germans, the British were coming by personally and on the phone and saying to Prime Minister Netanyahu, let it go, take your win. You stopped all those attacks last Saturday. This is a win. You don't have to go back at them. But the Israelis felt they did, and this was their response. We'll see where it takes us. It isn't obvious that it's over. But the Iranians have been saying publicly today they don't think much happened, and they don't see any particular need to respond. So,
all right, Ethan, let's get our focus back on kind of probably where it needs to be, which is in Gaza. What's the latest thinking about Israeli strategy in Gaza? It feels like a stalemate and status quo. What's the strategy here from the Israeli government?
So they're not being exceptionally open, as you can imagine, in the middle of their deliberations. There are, it's like a Rubik's Cube. There are all these things going on at once, including, of course, what's happening with Iran that we've just talked about. The Israelis began their attacks 6+ months ago. Recently, they pulled many of their troops out, but there remains in southern Gaza, in the city of Rafah, 5,000 to 8,000 Hamas troops in tunnels and so forth, and some 100 or so Israeli hostages. Israel has been repeatedly saying that it needs to go in there eventually and take them out so that Hamas can no longer be the kind of force to do what it did on October 7th. The Americans have been saying, be careful, please don't. What about all the people who are 1 million+ people who are taking shelter above ground in Rafah? So I think that my instinct at the moment is that there will be some time off here as we see whether this negotiation can get anywhere in Cairo about a ceasefire, and that Israel will begin to take steps to have the civilians in Rafah moved elsewhere for some kind of operation in the coming month or two. Its scale is very difficult for me to assess at this point.
Ethan, if I could tie these two together, does the fact that Iran has struck Israel out in the open, is there a sense to which this gives the Israelis more, I don't know, more impetus to say, look, clearly we need to be out there and we need to be strong, and again, this more hawkish attitude towards Gaza and what they say are Iranian proxies?
Yes, absolutely. But you see, it like everything, it's not one force at work here. And so what you said is true. On the other side of the equation is the fact that last Saturday, all these countries, including Jordan, Saudi Arabia, and other Arab states, helped Israel push Iran back. And Israel is feeling in the bosom of some kind of alliance and doesn't want to mess that up either. So, I think that what it wants to do is sort of show restraint toward Iran on its mainland and get everyone to accept that it needs to do something in Gaza. And because, as you say, Hamas is, after all, funded and paid for by Iran as well.
So, Ethan, you're based in Tel Aviv. You have a good sense of kind of the common person on the street. Is there any sense that among the people of Israel that there's a sense of fatigue setting in here? It's been 6 months here. They've basically occupied Gaza. Is there a sense of that maybe the people would like to move on to the next step?
There is some of that. I don't think it's overwhelming, though. I have to tell you, Paul, I mean, there really is a sense. What happened on October 7th is very difficult for those abroad to grasp the sense of trauma and defeat that it created in this country, the sense that its very existence is at stake, its ability to allow people to live at the edges of its country and not feel that someone is going to come in and carve them up and unprotected. It's been so overwhelming that I think that there remains a desire here among most Israelis to, quote unquote, finish with Hamas and make clear to other militias, proxies, and enemies not far away that Israel is willing to fight for its existence. So I don't think that fatigue is the overwhelming sentiment, although you are right that it exists. And there are many who say, we've done what we can, let's cut a deal, let's get out. We can't do this forever. But I don't think I think it's still leaning in the other direction for now.
Ethan, if I can quickly ask a military amateurish question, because this I don't understand, and maybe it's a minor point, but I'd just be interested to know, when Israel, we have reports of them launching these strikes, also a report of them striking a Syrian aerial defense position. Israel never confirms them. Their official line is always one of unconfirming. Why is that?
I think that their view, in particular with regard to, say, Iran, is that in particular today, they view that it allows them some kind of rhetorical and strategic flexibility to not specifically say what they did, They certainly acknowledge when they attack in Lebanon and often in Syria, by the way, what they say these are Hezbollah positions that we have taken out. That goes on. In terms of the sort of scarier stuff that goes on when they take out, you know, an alleged nuclear reactor, or when they do what they did today, they have found it useful to not talk about it publicly. I mean, you know, Israel has nuclear weapons. It's had them for years. It has never officially acknowledged them.
Ethan, thank you so much for this reporting. Ethan Bronner, Israel Bureau Chief and Senior Mideast Editor for Bloomberg News. He's based in our Tel Aviv bureau there. So, again, fluid situation there. Coming up, we're going to break down Netflix earnings. They reported last night blockbuster numbers, I thought, in terms of subscriber ads. Blew past the street, but a little bit more conservative on their guidance, and they're going to be not releasing as much information as they used to. Stock's down 6% here trading, so we'll break it down with Geetha Raghunathan, Chief of Bloomberg Intelligence.
headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lise Mateo. Stocks are mixed as the latest flare-up in the Middle East tension seemed contained. Right now we have the NASDAQ down 0.8%, S&P 500 down 0.2%. The Dow is up 0.3%. Over to the 2-year yield at 4.99%. That is little change. The 10-year yield at 4.63%, and that is little change as well. We'll head over to commodities. We have NYMEX crude $83 a barrel, Brent crude $87 a barrel, and over to gold, it's higher. We have spot gold at $2,390 an ounce. The debate over interest rate continues. A lot of Fed speak. Here's the breakdown. So we start with New York Fed President John Williams said even a rate hike is possible if needed, and that's while the Fed's Raphael Bostic, he said he doesn't think it'll be appropriate to ease until toward the end of 2024. And finally, we have Neil Kashkari, who told Fox News Channel that the Fed could potentially hold rates steady this year. We shall see. That is your Bloomberg Business Flash. Back to you.
All right, very good. Lisa Mateo, thank you so much. We appreciate it. We are here in a Bloomberg Interactive Broker Studio. Danny Berger sitting in for Alex Steele, who's on holiday today and all of next week. We are here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. That's the internet, Danny. YouTube.com. Search Bloomberg Podcast. Apparently, that's what the kids are doing
learn
these
something
days.
new every day.
They're on this YouTube thing. Tom is all over. Tom Keeney's becoming a new person here in this internet age. Talking about streaming and kind of internet delivery of media, it's all about Netflix. Netflix is a $250 billion market cap company. It's up 17% year to date, up 76% over the past 12 months, but it's down 6.6% today. I'm not sure what's going on there. I thought they had good numbers last night, but let's check in with somebody who gets paid to understand this stuff. Geetha Ranganathan, she is the media analyst at Bloomberg Intelligence. She's down in our Princeton office. Geetha, I thought it was a really good quarter in terms of, particularly the subscriber ads. Why do you think the stock's trading down today?
Yeah, it was not just a good quarter, Paul. It was an excellent quarter. I mean, they blew out subscribers, right? We were expecting, 4.5 million subscriber ads. They came in at over 9 million. It was the best first quarter ever, kind of almost reminiscent of COVID times. But I think why investors are a little bit spooked ever since they reported is because they said that they're no longer going to be providing disclosure on their subscriber numbers as well as on ARPU starting in the first quarter of 2025. And I think what that really signals is that this company is transitioning into this more mature phase. I mean, well, investors in the market likes transparency. And anytime you reduce disclosure, it really kind of causes a lot of uncertainty, a lot of anxiety.
If it's entering a more mature phase, Geeta, does that mean that this thing can no longer be priced as a growth stock, that the era of adding on huge amounts of subscribers, growing like gangbusters, that's over, and so this repricing in that scenario makes sense?
So, there are a couple of different things here. I think with the whole streaming wars and the media landscape as a whole, I mean, there has been kind of this shift away from this hyper-focus on just subscriber growth. I mean, there was going to be eventually some type of a wall or some type of a ceiling. The question was where it would be. Again, that question is still an open question. But I think what you have to remember with Netflix is, yes, there is going to be some limits to subscriber growth. I think we're going to see peak subscriber growth this year. It is going to start to decelerate a little bit. But I think what Netflix has managed to do, being a first mover in this space, is really scale and operating leverage. And we're seeing that in the profitability metrics. We're seeing that in the operating margin. We're seeing that in the free cash flow. And they are just way ahead of their peers. And so I think, yes, valuation might have to take a little bit of a more modest kind of approach or has to be maybe a little bit more cautious here. But at the same time, I mean, this is a very different company from your traditional media company because most of them are still losing money on their streaming business. Meanwhile, you have Netflix generating close to about $9 to $10 billion in profit this year with a 25% operating margin.
Yeah, just amazing what they've done there in terms of getting to profitability, which begs the question, Geetha, how about, you can be a very profitable streaming company. We see that with Netflix. Do you think the Paramount Pluses of the world, the Disney Pluses of the world, all the other pluses out there from the media companies, can they get to a similar level of profitability too? Because right now, as you mentioned, the streaming business has been a money loser for most of the traditional media companies.
Yeah, so exactly to that point, Paul, last year when Netflix reported about $7 billion in profit, all of these other streamers combined reported the exact same amount in losses. So they lost about $7 billion. And, it's going to be a little bit different story for each one of them. I don't think all of them can necessarily get to profitability. So Disney is almost on the cusp of profitability. They're probably going to break even in a couple of quarters. They have all the levers in place to kind of really make it a very profitable business. Of course, it's going to take them some time to get to the levels of a Netflix, but they definitely have the formula. When it comes to Paramount, I think that's going to be a completely different story. The company is still losing money. It will probably lose about $1 billion, $1.2 billion. Plus, they have too many other distractions going on. With Warner Brothers Discovery, yes, they did turn a slight profit last year with, Max. But, Paul, you really have to kind of look at this in the context of the Warner Brothers Discovery business. I mean, HBO in its heyday, this is HBO, which is basically turned into the streaming business. In its heyday, was generating $2 billion in EBITDA. And last year, they reported $100 million on their streaming business and EBITDA. And, if they want the street to be excited about that, I'm not so sure, investors are going to be too happy. So they're not going to be able to get to the level of profitability and definitely not going to be able to get to it in the time frame that investors are hoping that they would.
So Netflix might have won the battle there, but Keith, the one battle that seems yet to have been won is who's the dominant sports streaming place. You have Netflix with the WWE Raw deal, and then you have this other platform which we heard be announced earlier in this year, which, to be honest, I feel like I've heard nothing of since, the ESPN, Fox, Warner Bros. Discovery. I don't even think we still know what a name is. We don't know whether it's going to happen, whether Congress will even allow it to happen. How is that shaping up in terms of who becomes the go-to player to watch all of your live stream sports?
Yeah, that really is the question right now. And Danny, you kind of really hit the nail on the head there. We're going to have to wait and see what happens with, the joint venture, the ESPN, Fox, Warner Brothers. In the meantime, Disney has also said that they will take ESPN standalone over the top in 2025. But in the meantime, you do have all these tech giants kind of making a play for sports, right? Amazon, I think, to date has been the most aggressive. They have the Thursday Night Football package. They've now introduced ads on their service. They have a lot of the football content from Europe. So, they're definitely making a big play. And as you mentioned, Netflix too. I think the big thing that we are kind of really watching out for is this July 20th event where they're kind of dipping into live sports a little bit with the Mike Tyson versus Jake Paul. And that kind of then gives them, I think, allows them to gauge a little bit, what the appetite for live sports is. Because remember, again, WWE is a little bit of quasi-sports. It's more what they call sports entertainment. But it's going to be interesting to see whether they really want to go go really aggressive with sports. I think if they want to build their advertising business, I think it is a critical piece that is missing for them right now. And so there is this chatter and this speculation about whether they're even going to be this dark horse bidder for the NBA negotiations that are currently ongoing.
All right, Geetha, let's switch gears to our good friends at Paramount. The stock's up about 10% today. The news, I guess, is Paramount shares jump as Apollo and Sony are said to weigh a joint bid out there. What's the latest there? Are we going to get some kind of deal here for some of Paramount, all of Paramount? How do you think it shakes out?
I certainly hope so, Paul. I mean, it's Sony kind of getting into this equation. I think they are the most credible bidder to date. And, I really hope that they come in with something that kind of